New York City on this Monday, November 25th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, stocks kick off the week in the green as investors cheer Trump's choice of Scott Bessent to lead the Treasury Department. The dollar fell, the U.S. government bonds rallied after the nomination as investors are expecting Bessent to take the sting out of President-elect Trump's more aggressive trade and economic policies. In an interview with the Wall Street Journal this weekend, Bessent said his priority will be to enact Trump's tax cuts while also introducing tariffs and cutting spending.
An earnings season continuing this week. Results from CrowdStrike and HP, plus a slew of retailers set to report. The big news out this morning, Macy's shares are falling after delaying its earnings report. Now, the retailer disclosing an investigation revealed that an employee had hid over $100 million of expenses.
And fresh economic data and Fed minutes this week. We'll get all of it. It's going to offer us some insight into the central bank's fight against inflation. Traders will closely parse through the Federal Reserve's November meeting minutes, consumer confidence, and PCE data, the Fed's preferred gauge of inflation, to help assess the outlook for rate cuts next year. Wall Street strategists remaining optimistic that stocks can continue to rally this year and next year as they expect solid economic and earnings growth and additional relief on inflation, according to RBC Capital Markets. Goldman Sachs, they expect to see the S&P 500 rally 4% alone in the next month. U.S. stock futures in the green to kick off the shortened trading week. Wall Street strategists, they're out with some more bullish predictions for this year and for 2025. You've got Goldman Sachs saying that this week will kick off a year-end rally that will take the S&P 500 up above 6,200. There you're taking a look at the U.S. stock futures here this morning. We're seeing green across the screen for the Dow, the S&P 500 futures, and the NASDAQ futures, the tech-heavy average up by about 0.7%, and really diving into some of the outlooks that we've seen, whether it's Goldman, whether it's Barclays. Barclays, they have their own call for 6,600 for 2025 that just came out here. And as we're continuing to think about what that means, they're looking at some of the EPS growth and the total S&P 500 EPS estimate of $271, up from $268. And so all of that considered, they're looking for even more exceptionalism in U.S. tech, really driving this, and a virtual cycle between income and consumption remaining intact as well.
Yeah, I think both equity prices and profit expectations are right around those record highs. So that has really been driving so much of the sentiment that we have seen now for quite some time. You talk about that euphoria that has really swept the markets going back to the last 18 to 24 months when this talk really started I guess more so resonating with investors when it comes to AI and the potential and what we are seeing there. That certainly had been the leader now. And as we get toward the end of the year, we're talking about more of a broadening, a market breadth that has been so critical. We've heard from so many strategists on the show over the last several months that we need to see that in order to continue this momentum to the upside. You mentioned some of the calls out this morning. One from Lori Calvasina over at RBC caught my attention. She talked about the fact that she actually sees the S&P 500 set to reach 6,600 by the end of 2025. But within that, she does break down the fact that she does bake in the idea that we could see a 5 to 10% drawdown as well before too long. You talk about some of the froth and sentiment right now, higher valuations, leaving the S&P 500 vulnerable. And that is also a common theme that we have certainly seen from so many of these expectations or look aheads that we are getting now from Wall Street into 2025. Yes, there's lots of reason to be optimism, but don't be too discouraged if we do see that 5 to 10% pullback, because many are arguing that that is well overdue at this point.
Absolutely. Well, we've got a lot to really dive into here on the day. President-elect Trump on Friday announcing billionaire hedge fund manager Scott Bessent as his pick for Treasury Secretary. Stock futures and bonds rally on the news. Joining us now, we've got Ed Mills, who's the Raymond James Washington policy analyst. Ed, just want to start off with your reaction to this pick.
I think for Donald Trump picking Scott Bessent for Treasury Secretary, this is the exact pick the market wanted. Someone with significant investment experience, especially in the macro environment. If we look at the Trump policies on trade, on tariff, having someone who understands the knock-on effect of that and can help position the United States to mitigate that especially in other parts of his agenda. I'm sure we'll talk about tax cuts. I'm sure we'll talk about deregulation, but this is who the market wanted. And getting this pick is part of the reason why we see futures in the green this morning.
One of the things that is really jumping out to the street this morning is maybe it's going to lead to a more measured approach. We talk about some of the extremes that we've heard from President-elect Trump, and very much that maybe is the driver here to this morning's early market reaction to this pick. We actually got the chance to speak with Scott Bessent earlier this year, back in July, about then candidate Trump's proposed 60% tariffs on China. I want to play a quick soundbite of what we heard from Bessent.
We hear 60% tariffs on China. That's the beginning of a maximalist negotiating position. That's the way President Trump negotiates. I would be surprised if we ever hit that. But I think, given his record in Trump 1.0, he has a lot of credibility in using tariffs to negotiate.
And are you confident that we are going to see that more measured approach? And I guess maybe what should investors then be expecting when it comes to some of these policies?
Yeah, Shauna, here at Raymond James, we put out an investor's guide to Trump 2.0 as it relates to taxes and tariffs last week. And it's exactly what we said. There is going to be a certain part of the Donald Trump agenda that is trying to pursue that maximalist pressure. But Trump is also a negotiator. So when we see Howard Lutnick at Commerce, that's the maximalist at Commerce pushing for that. At Treasury, this is a good balance, someone who has called for this to be layered in, someone who will be directly negotiating with Congress on that tax bill. And my expectation is in that tax bill, they're going to give the president new authorities to enforce reciprocal tariffs. And so what Donald Trump will say to countries across the world is, if you have barriers on U.S. goods, I am going to put on tariffs. If you are willing to take those tariffs off, we can do a free trade agreement. So anything that's balanced, anything that's layered in is going to be viewed as a positive to this market versus kind of that maximalist, impulsive push for tariffs on day one.
Scott, or Ed, I'm sorry, Ed, as we're thinking about the Treasury pick here, Bessent, and understanding more broadly what people should expect to come forward, I like the way that you kind of summarized it in the three arrows and the prongs that people should expect. Summarize that for us and why that matters for the markets.
Yeah, so Mr. Bessent has a 3-point economic plan, the three arrows of 3% GDP growth, reducing the budget deficit down to 3%. The big question I have is reducing it via growth or through the cuts that we have at DOGE, and then increasing U.S. energy production by 3 million barrels a day. To the extent that that is a economic policy of the Trump administration, I think the market certainly would cheer on that predictability. We've highlighted some of the areas where if it is more on those cuts on getting that 3%, because we've been hovering in the higher 8, 9, 10% range over the last couple of years. If we're trying to do that through cuts, that's where the market in specific sectors, we're thinking about defense, other government services as the losers there. But if those are the economic policies of this administration, those are very market positive policies, something that will be cheered on, Brad.
And what do you think this tells us? Just the fact that Trump didn't go with Lutnick, and we know many of his allies, many of his close supporters were pushing Howard Lutnick as the pick for Treasury Secretary. Does that really show us that maybe Musk does have some sort of, there is a limit to the influence that he does have over the incoming Trump administration?
Yeah, I think for me, it was Scott Bessent was the front runner all along. And so there is a nice part of having someone who we anticipated getting the role, actually getting the role, something that happened in Trump 1.0. It was Stephen Mnuchin all along, actually got the role. Lutnick getting a role within the administration over at Commerce where he can direct the tariff policies, maybe oversee the U.S. trade representative. That's a good balancing act, as I mentioned. I think it would have been more destabilizing, more concerning if Lutnick was the Treasury pick for this market because of his aggressiveness on tariffs and the way in which he's embraced it. So to me, this actually shows a return to the predictability that the market is seeking versus anything that is a surprise. As it relates to Elon Musk, he's going to be incredibly influential, but one of the big questions is there's a shelf life for a lot of individuals around Donald Trump. If he does not think that he has the influence, Does he move on to a different project? Is there a falling out? That's what we're focused on at Raymond James as it relates to the impact of his Doge initiative and how successful that can be, Shauna.
And let's push this forward real quick. The next steps. You talk about the fact that we don't have an NEC chair, obviously, yet. You talk about some of the key Treasury personnel. What do you think this pick then tells us about Trump's likely picks that we could see in those positions?
Yeah, for the banking regulators, I think this is absolutely part of the deregulatory playbook and something really favorable for financials, especially banks, a lot of M&A. At NEC, the National Economic Council, we're looking to see who gets that job. Is it Kevin Warsh, the former Fed governor? Does he establish a kind of shadow Fed position from within the White House? At Raymond James, when customers ask what their biggest concern is oftentimes the independence of the Fed. Anything that would disrupt that would be unwelcome news to this market.
Ed Mills, always great to get your insight. Raymond James, Washington policy analyst. Thanks so much.
Thank you.
Well, markets are excited about Scott Bessent as the pick for Treasury Secretary, with bond yields and the dollar as well as gold all falling as futures are pushing higher this morning. Joining us now for more, we want to bring in Jay Woods. He's Freedom Capital Markets Chief Global Strategist. We have some of the reaction up there on the screen. You've got futures, Jay, pushing to the upside here this morning. I'm curious to get your interpretation of how Wall Street is reading this pick.
Yeah, I mean, the pick was what we were expecting. No surprises, just like your previous guest had said. So it's business as usual in a bull market. And what we're seeing is stocks run to the forefront, continued rotation in this market. And we're seeing some technology sectors like software and now cyber start to lead the tech sector. And we're waiting on NVIDIA to take that next leg higher. It kind of stalled last week, but wasn't a bad thing. Resting is sometimes what you do before you take that next leg higher. So as for the pick, it didn't really move the needle one way or another. I just think we're going into a holiday shortened week. We're going to focus on data, and these picks will move markets minute to minute, but overall, it's not going to impact us that greatly.
Is there a pick that the markets could sour on then to the other side of that? Because we've seen a lot of potential names be put out for a range of positions. And so at this juncture, it seems like the market, at least on the back of this Bessent news, have enough to kind of get a sense of where Trump is going to be bringing in some of the adults in the room, if you will.
Yeah, well, this is the pick that we were focused on. We don't get mixed up in the political headlines and, what loyalist candidate was appointed to what and how that's going to impact the world. We just want to know what's going to impact the stock market. Yeah. And for this pick, this was a good thing. He's going to push back a little bit on the tariffs. So we had some concern that we could go a little overboard. We saw what happened in Trump 1.0 when that tariff started. It was, I believe, January, first quarter of 2018, and we saw a 10% correction from a very strong bull market. So right now, no, we're going to focus on earnings. We're going to focus on year end. We've got nice tailwinds as we go into things, and we continue to see rotation in this market. To me, that's a positive, and let these headlines in the Trump administration play out. I'm just focused on the market.
So let's talk about where we are here this morning. When you take a look at the S&P, right around that 6,000 level, not too far from regaining that. What do you see as the upside between now and year end and looking ahead to 2025?
Yeah, I think, knowing as a technician, the trends and the patterns we're seeing, I expect us to have probably a 10% gain between now and the end of Q1. So you get 5% now, you get 5% there, you do the math at 6,600, boom. I don't like to just throw out those numbers, but it is quite simple. We have leadership that continues to change. What was the big sector last week? Materials. Who saw that one coming? Before that, energy. Energy was the lagging sector before the election. Now it's one of the big sectors. Guess what? Energy ran up on the first Trump election, and guess what? It came back in. So this is what I like to see, technology right in the middle of the pack. I still think technology is where you want to be over the long term, but healthy. We're going software, we're going cyber, we're getting away from some of those big, magnificent names in Apple right now, but it will have its time, and this is exactly what I want to see set up as we go into the first year of Trump. And then here's a fun fact for you. In 2017, first year of the Trump administration, we talk about the headlines and these crazy picks. What did the market do? It went up 19%, up every single month. Slowly but steadily, not 2% drawdown in all of 2017. You talk about volatility and headlines, we got that. But the market didn't care, it just soldiered on. And I think the setup, as we see, he's inheriting a bull run. He's going to continue it. He loves the stock market. He's autographed copies of Up Days. We remember those days? Those were a little crazy. So he uses that as a scorecard, and I anticipate in the first few months at least, we'll continue that uptrend. We'll see what the second half shakes out to be.
We only got 15 seconds, so we got to go yes, no. With this next FOMC meeting, do the markets need to see a cut in order for a Santa Claus rally to be locked in?
No, we don't need to see a cut. In fact, I'd be surprised at this point we get a cut. Watch the PCE on Wednesday. We've got a little dovish rhetoric turning hawkish. To me, we're in a good place, but we want to stay on the downward slope. But right now, I don't think a cut is mandatory come December.
Jay Woods of Freedom Capital Markets. Thanks so much for taking the time this morning.
Thank you. Go Birds.
Go Birds. Guys, coming up on Morning Brief, we count you down to the opening bell on Wall Street as stocks look to open, in some Kelly Green. Plus, we dig into Macy's prelim results as the company delays earnings. Details to come on that one. And we'll also hone in on big tech in Washington as the DOJ looks for a historic win against Google, Alphabet, whatever you're calling them, call them going to war with DOJ right now. We'll discuss that and much more on the other side. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, Macy's, they were set to report third quarter earnings this week, but the release has now been delayed until December 11th after an investigation revealed an employee hid more than $100 million in expenses. Still, a slew of retail earnings are on tap this week. You've got Best Buy, Nordstrom, Kohl's, Dick's Sporting Goods, all set to report and provide further insight into the health of the consumer as we head into the busy holiday shopping season. Joining us now, let's bring in Stacy Widlitz, who is the SW Retail Advisors President. Great to have you here with us today. Let's just start on Macy's here, especially as we've already got some of the preliminary results, and we can compare that against some of the consensus estimates coming into this. One of the headlines that a lot of the investors and analysts out there might be focused in on, net sales were down by about 3.1% during the quarter, comp sales down by about 3% as well. What does that spell out to you about some of the challenges beyond a rogue employee at Macy's?
Well, beyond the rogue employee and the $100 million missing, I think, what we've seen for the past couple of years, this is nothing new. Department stores are losing traffic. They're losing share. Macy's is no exception. Really, you've looked at brands and retailers that have grown, double digits to be conservative since pre-COVID, and Macy's really just hasn't grown, and they continue to comp down. I think right now it's very much when you look at the department stores, whether it's Nordstrom or Macy's, it's the focus on a flat to slightly return to growth and keeping operating margins intact. We certainly have been through a period where there's less promotions generally in the marketplace right now, which is a great thing. And it's helping everybody who's underperforming on the top line because they're not having to keep up with the neighbors and give away product in order to get people through the door. And that's very much what I saw over the Black Friday weekend. Promotions were generally flat to leaner with a few exceptions.
And just to clarify too here, I mean, looking across the Macy's net sales, Macy's Maine, that were down, as I was mentioning before, versus Bloomingdale's and Bluemercury. Bluemercury, that was also up for comp and net sales, and then Bloomingdale's up both on a comp and net sales basis too. You know, what does that signal to you about just the mindset of the consumer that we're seeing even going into this holiday season that could permeate and overflow into 2025 as well, where there's more of a prioritization on the little luxuries in that Bluemercury segment, and then you still do have the luxury spenders out there still at least picking through the aisles, if you will, or online?
Well, beauty's been on fire, right? And it still is. Even Target, that was a significant underperformer from last week. The stock was down 20%. You know, beauty was up very nicely, and that's been the story. If you look at e.l.f. results, we'll hear from Ulta soon. And that's obviously where people have been spending money. So I expect that to keep working here. It's really the discretionary, the general merchandise category that's been tough. And there's certainly been a little bit of deflation there. And of course, you've seen the likes of Walmart, which is gaining share of the higher end customer across the board. Their majority of their comp store sales gains came from the wealthier $100,000 and plus customer. So that tells you a lot about consumer behavior and how, everybody's looking for value here. You look at TJX's numbers, incredibly strong, traffic up. So I think the customer's really looking for value. And there are definitely spots, for example, Abercrombie, we're going to hear from this week, that is still outperforming. Margins are intact. Promotions lower at Hollister as well. So there are a couple brands that have had real turnarounds that have staying power. And in addition to that, you look at the value players, and that's where the traffic is going.
Yes, Stacey, you have a couple of, you phrase it as winning the turkey trot so far. You just mentioned Abercrombie. You also like Aerie. You also like Deckers here. Gap is also on that list. Is there a common thread among those picks as to why you see them outperforming at this time?
Yes, and these are specific turnaround stories. For example, the Gap. Gap was just promoting. The merchandise had fallen off. Same thing in Old Navy. Now you're seeing better marketing campaigns, better merchandise. And by the way, the promotions are down year over year. So now you have a better operating margin. So, that's one bucket. Certainly Abercrombie has cast a much wider net of their consumer. It used to be younger and very specific. Now it's widespread, it's party dresses, it's you would throw Anthropologie in the same bucket there. So I think they're very specific turnaround stories. And again, the second bucket would be that, the consumer is looking for value. Inflation has been, absolutely killing the mid to low end consumer. And they're going to Walmart for the best bang for their buck, particularly on groceries.
All right, Stacey Woodlitz, SW Retail Advisors President, thanks so much.
Good to see you.
We're taking a look at another trending ticker today, Tesla. UBS saying that the stock's recent rise is being driven by animal spirits rather than actual improvement in the company's fundamentals. That's never stopped Tesla before. You're looking at gains of nearly 3% here ahead of the open. It's not stopping the momentum at all if you take a look at this morning's trading action. But going into this note, the team is led by Joseph Spack over at UBS. He's talking about the fact that removing consumer tax credits from EV purchases, for example, could force Tesla to have to cut prices here. He also noted that while regulatory environment under Trump may be more conducive to AI ventures, he also went on to talk about the fact that Tesla does not have a robotaxi ready to take advantage of the relaxed rules. So we certainly have seen this enthusiasm, to say the least, surrounding Tesla stock since we got the election results not too long ago. The stock has added about $350 billion of market cap since election day. So that just speaks to the excitement by investors, regardless of whether or not the fundamentals, I guess, support it.
Yeah, look, there's going to have to be a lot that goes right for robo-taxis to be real in the realm of the roads that we are on day in, day out right now. I mean, right now, the company, even within the most recent earnings call, was talking about just two states out of 50 that could potentially see more lax regulation to come, that being California and Texas. And so even with that in mind as the test cases, you're going to need to bring on more states to really satisfy some of the larger investor appetites for being able to scale this out more broadly when it comes to robotaxi. That also, and the cybercab, I should say, that also plays more largely into the theme that a lot of investors have really started to navigate towards, which is Tesla as an AI play, Tesla as an AI company, because of all of the ingested data and that being able to inform everything from the dojo into the cybercab and how all of those things come together. That really formulates and solidifies why there is more of the belief that this could receive an AI multiple at some point. Is it already there? I don't know. But I think at some point, what we've seen from Tesla come forward, at least in statements, needs to come to fruition more than just promises, which it's missed that on the Cybertruck. It's missed that on timing for the taxi service as well to this point, too. All right, let's talk Intel. Intel, according to the New York Times, the Biden administration is trimming Intel's chip giant. What was going to be an $8.5 billion grant will now be less than $8 billion after the government considered $3 billion. The company is receiving to make chips for the U.S. military. Shares right now, they're up by about 1.8%. Don't look now, we will for you, but Intel stock, it's been a bumpy ride to say the least over the course of 2024, down a little over 48%, I believe, is what I have on my screen. Oh, there you're taking a look at the year-to-date move, 51% lower over the course of this year, despite some of the fanfare that certainly transpired early in the year in the first quarter because of grants like this.
Yeah, certainly. I think we're seeing this move to the upside, even though it might be less than what was initially expected here for Intel. It's the fact that they are getting cash awards, something that Gelsinger, the CEO, Pat Gelsinger, CEO of Intel, has very much expressed a frustration with over the last several months here. Many of the interviews that he's done, even those here on Yahoo Finance, he has presented some dissatisfaction with the fact that they have not yet been able to receive those cash awards. So yes, they have benefited from some of those tax breaks that were included in the CHIPS Act, but not the cash awards yet. So the fact that this is coming, that is being interpreted as at least a step in the right direction. But you are right. When you take a look at the New York Times report that was out over the weekend, talking about the fact that it actually might be $500 million less than what was initially anticipated. You could look at that as it may be a bit of a disappointment here for Intel, but overall, they could be getting, it looks like they are getting the $8 billion of cash. So again, a great step here for Intel at a time when it's very much needed. All right, keep right here on Yahoo Finance. We got much more of your market action ahead. You're watching Morning Brief.
Just seconds away from the opening bell. There you're seeing some clapping, some cheering taking place. People are absolutely besides themselves as we're about to begin this holiday-shortened trading week here. There you're hearing the opening bell at the NYSE. Global Ship Lease ringing the opening bell up there on the podium. And on the linoleum floors over at the NASDAQ, you've got the great folks from YHN ringing the opening bell. Some funfetti for you, and you get some funfetti, and you get funfetti. You get the picture. All right, that's the opening bell. Let's do a quick check of the markets. Dow Jones Industrial Average right now higher by about 0.8% to start off today's trading activity. We're also taking a look at the tech-heavy NASDAQ. That begins the day in positive territory. We like that. That's up by about 0.75%, we'll call that. And the S&P 500, that too, seeing some gains to start off today's activity. As we always love to do, 11 S&P 500 sectors. We've got them loaded up for you here on the screen. We're doing the work so you don't have to. Energy pulling up the caboose, but it's still positive. That's good. We've got all 11 sectors in positive territory, and we're led right now by consumer discretionary. Big week for some consumer discretionary names as we get a host of retail companies that are going to be reporting. Since we've got a little bit of the retail vibe going on here, I don't think I'm going to step on Jared's toes with this one. So I'll just go ahead and take a quick look at some of those retail names since we're going to get a bevy of them reporting over the course of this week. We'll just make this equal view so that you can see all of those names. Dick's Sporting Goods, one of them that we're going to hear from. Macy's, we already heard from them. They're actually moving lower on preliminary results. And an employee, Tisk, who had something to do with some accounting issues over there. So ultimately, that's being priced into the shares here on the day. And then we've got some other big names. Best Buy also coming out this week. So we're going to continuing to keep close tabs on the retail sector. For much more on today's opening cross, let's get on over to Yahoo Finance's Jared Blickery. He's got a full look at what's moving. Hey, Jared.
Thank you, Brad. And I'll get to retail in a minute. Big week here, and retail is one of the leading sectors since the election. But I want to go to the Russell 2000, and let me show you a 3-year chart. Let's make it a 5, and I'll put some lines here so you can see that we are right back up to these highs that we saw in 2021. There's a lot of excitement for the small caps. Might they finally make that record high? They have been the laggards so far, but on this latest rebound, they have been leaders. So lots of expectations there. Just want to remind that if this ends up being a cup and handle, well, that handle could take another few months, maybe even a few quarters. So you might have to sit on your hands for a little bit. Want to take a look at the bond market because the 10-year T-note yield is down by the most in 3 months. That's a 5-year chart. So let me zoom into a 3-month, and you can see we are heading down off of these relatively recent highs. These are the highest levels we've seen in about a year, and that's pretty significant. That was putting some pressure on the risk markets, and that was also being expressed by a higher dollar, but the dollar as well is down. And I think this is off of the Treasury Secretary announcement, just kind of a sigh of relief there. So that's probably behind that. And I think that erases some of the concerns over the dollar in the meantime, but very close to those highs. We want to keep an eye on that, especially with regard to its potential to be a wrecking ball. This is, just go over the sectors real quick. It's retail. Now we have interest rate sensitive sectors leading real estate and utilities. We had tech leading early, but that is now down to the second best place, but everything's still in green territory here. If we check on our leaders, XRT in the upper left, guess what? That is a retail ETF. So just confirming something what we've been talking about. Solar, it looks like biotech, regional banks, disruption stocks, and home builders. Really interesting mix of not only risk, but also value, but also some interest rate plays there. Those are leading today. What's taking a back seat is Bitcoin. Just wasn't able to punch through to 100,000 over the weekend. We'll see what happens this week, and we got some more holidays towards the end of the week. Want to go back to, let's take a look at the EV sector. I wanted to show you what's going on with Tesla. I'll put on a 3-year chart there. This is opening up at a 2-year high, 2 or 3-year high. So if it climbs into positive territory, that will be the highest amount in 3 years. And of course, the record highs are a little bit, are a little bit above that. So a little bit of territory to reclaim those highs, but a lot of excitement over Tesla as well today. Shauna.
All right, Jared, thanks so much. It's time to get to our today's strategy session. Wall Street strategists are betting on more gains ahead, with Goldman Sachs out with a call that the S&P 500 will see a 4% rally into year end, the benchmark topping 6,200. Those are the expectations. Let's talk about it with Jimmy Lee. He's Wealth Consulting Group's CEO. Jimmy, it's great to have you back here on Yahoo Finance. It certainly has been an impressive year, to say the least. When you take a look at the S&P, up 26% since the start of the year. Do you think there's more room to go, and why or why not?
I do, Shauna. Thanks for having me on, and good morning. Well, I think at the beginning of the year, if you'd have asked most analysts where they thought the S&P 500 was going to end up, certainly 6,000 wasn't very, very popular. But look where we're at today. We've had a dramatic rally. As you guys were just discussing, I think one of the healthiest parts of this rally is that now we've got the value parts of the market participating. So I think, investors are trying to get some of that money, record money, out of cash, and maybe not necessarily chase, but look for areas where there are some values, such as the cyclical sectors, such as small cap stocks. We're very happy that we're seeing things broadening out beyond the Magnificent Seven. And I do think that we could have a nice little rally going into the end of the year. Certainly historically, end of November is typically good. I think that the election's taken one of the big variables out of the people's heads and investors' heads in terms of what's going on. I think so far, with all the cabinet picks, people are going back and forth on that a little bit in terms of what they think. But for the market, I think investors are very hopeful for next year, going into a lower interest rate environment with less regulation. And you're starting to see a little bit of these animal spirits that we talk about.
Even with the slight pullback that we saw mid-November, that's still had a lot of investors thinking, okay, what are the dip buying opportunities that we should still be most excited about? Are there opportunities, if we do see pullbacks or any type of chop, even going into the year end and with any rally in mind, that you're anticipating here that would present such an opportunity? And if so, where?
Brad, I think that, when tech sells off, although we don't think that people should be too overweight the big tech names that have gone up the most, which led the market up so far going into the fourth quarter, we think that tech could also be a potential buy on the dips, though, on the pullbacks. And but I am a little concerned that too many investors, I talked to too many people that have the names like NVIDIA, that it's gone up so much, and they're holding on. And so I'm a little cautioned that the retail investor has too much of that in their portfolio. So I think diversification for them is important. That being said, I do like those cyclical sectors. And I like small cap. I even like the idea of potentially the dollar going down as a theme over time, and international stocks may be performing a little bit better. So we'll see how the tariff game plays out with Trump getting back in, and how aggressive that gets or not, and see how that disrupts China and overseas markets in Asia. But with that being said, I actually am a little bit bullish about some of those areas too that just have not been participating. And if you look at the rest of the S&P 500 outside of the Magnificent Seven, in the fourth quarter, we're going to start seeing this earnings shift to those names. And I think what we're hopeful for is that earnings are going to catch up, to where the valuations are for the market.
Jimmy, going back to what you were just saying about Trump's policies, is it going to be more of a wait and see then approach from your perspective, just in terms of the investment allocations and any changes then that you're making to your portfolios?
We caution investors not to take too much into consideration when it comes to who's in the White House or Congress for the allocations, but certainly we need to pay attention to that. I just think that what we're seeing now is more of a kind of a bullish story for investors, period. And the idea that earnings possibly could keep up with stock valuations, but there are those areas that are very expensive, right? So that's why I think there's a little bit of a cap on what we're seeing with tech on days like today, and where we're seeing, like last week, small caps did a lot better than the technology and bigger stocks. And so some of those sectors like financials, industrials, cyclical sectors like that, we've liked it all year long. Small caps are starting to finally catch up. In fact, small caps have performed better than S&P 500 as of about 10 days ago. I don't think a lot of investors know that. Most investors are underweight small cap as well as international stocks. And international stocks have suffered for a long time. But I think that's potentially a good area. Also, bond investors, with the 10-year shooting up and surprising a lot of people after the first big rate cut by the Fed, I think bond investors have something to look forward to too as well next year, as I think the 10-year is going to come down.
I'm looking at probabilities for the December Fed meeting here, Jimmy, and we posed this question earlier in the show. The probabilities right now are actually looking at about 55, 56% towards a cut here versus 44% keeping the rate the same at the December meeting. Does this market need a 25 basis point cut in order to see a Santa Claus rally locked in?
Brad, I sure would like one. I know that the futures market, after Powell said that he doesn't have to be in a hurry to lower rates, People didn't like that. So I do believe interest rates are too high. I think it affects an area of the market that's very important to consumers, which is housing. So we'd like to see housing get more in balance with more houses on the market. So the supply and demand is a better match. We're starting to see numbers slow down in the new permits and home construction. So we could be in a little bit of a shortage down the road. So I think interest rates need to come down sooner. And so I'm hopeful that the Fed does cut 25 in December. I don't think it'll be a disaster if that doesn't happen, but certainly that would definitely be a damper on a Santa Claus rally.
Jimmy Lee of the Wealth Consulting Group. Jimmy, good to see you. Thanks so much for taking some time here with us after the opening bell.
Thank you.
It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at what Trump's Treasury Secretary pick means for the economy. Hey, Maddie.
Hey, Brad, so take a look at this chart behind me here of the ballooning U.S. debt. This is about to be on Scott Bessent's balance sheet when he becomes the Treasury Secretary. He's going from about $600 million in assets under management to $35 trillion of debt to take a look at here. Now, he has talked about his three arrows approach to this debt. To quickly run through that, he wants to cut the deficit by 3% of gross domestic product by 2028, spur growth of GDP to the tune of 3% through deregulation, and he also wants to produce an additional $3 million of oil barrels per day in the coming years here. So that's a pretty growthy backdrop. And usually that would present a central bank with a situation where they're having a lot of growth. Maybe they have to keep interest rates higher for longer. Higher rates typically mean a higher US dollar. But it's actually interesting. If we can flip the board over to the dollar today, we will see that the dollar hitting its lowest lows since November 7th, since that election result. And you can see that dip just at the end of this chart here. And part of the reason behind that, when I'm taking a look at some analyst reaction this morning, is this idea that Bessent might moderate some of Trump's growthier or potentially inflationary policies. In my own conversation with him here on Yahoo Finance, he talked about the idea of coming in with those 60% tariff suggestion as a maximalist policy. He doesn't really see that actually coming to fruition. And this idea that given that the delay happened with Trump's Treasury Secretary pick, that we also are potentially not necessarily seeing Trump's economic policies be really kind of hammered out at this point in time. We're still waiting for those economic policies to really kind of get some clarity around them moving forward. So all of that question in the room, combined with the fact that Bessent has potentially put out this idea that he is not necessarily going to go 100% with every single policy position from Trump, that could be part of the reason why we are seeing a little bit of weakness on the dollar here. Also, Citi's global head of research had a note out in reaction to the dollar move this morning, saying that they're going to short the euro relative to the peso moving forward here. They see the peso as a potential beneficiary here, coming off less badly on the heels of those tariffs relative to what we could see in China and Europe. So I think that's just something for investors to watch out as a potential contrarian FX trade as we move forward here, guys.
All right, Maddie, thanks for pointing that out. We've got much more on today's market action coming up. Stay tuned. You're watching Morning Brief. The hype surrounding AI benefiting names across cloud and hyperscaler space over the past year or so. Wedbush now saying that the AI revolution is hitting its next phase. Software stocks are next in line to surge. Let's talk about that and more. We want to bring in Scott Devitt. He's the managing director of equity research at Wedbush Securities. Scott, it's great to have you back here on Yahoo Finance. So to put it in Wedbush's words, AI revolution hitting its next gear. What does that look like?
Well, you have the first part of the cycle, which was the semiconductors, making significant amounts of money as the cloud companies changed their architecture to be able to perform in an AI world. And now you're getting to the AI application phase of the cycle, which should benefit software companies as well as the cloud providers. And then phase 3 of this will ultimately be the consumer facing companies, figuring out how to use the technology in ways that actually can drive increased interactions with consumers. So we're entering phase 2 in 2025, which is going to be very good, we think, for software companies and for cloud providers.
And so with that in mind, I mean, one of the elements of, and perhaps that sits at the Venn diagram of that, is cybersecurity as well here. How do you envision AI really advancing and helping these cybersecurity companies sell their advancements that they can make and the client base that they're able to service even more so as a result of AI, selling that to the analysts and to the investor community?
So anytime there's an increase in activity, consumer engagement, and usage of technology, that leads to the opportunities for bad guys to enter the scene, which is what benefits the cybersecurity companies considerably. And so as we kind of enter this next phase, it also should benefit the cybersecurity companies, as well. And so that would be part of this this theme entering 2025.
Scott, when it comes to some of that outperformance, are there specific names that you think or the team thinks is best positioned at this juncture?
So Dan Ives leads the software segment coverage, and some of his ideas include Salesforce, upgraded Elastic and Snowflake today, and also has been recommending Palantir as well. And so those are names that I would highlight. On the consumer facing side, or the ones that have the cloud hyperscaler businesses built in, of course, Amazon would lead that in my coverage, and then followed by Alphabet.
And so all of those things in mind, as you're thinking about what type of investments they're continuing to make, how are you kind of grading the capital expenditures that you're hearing from these companies and the timeline for which they pay off?
So they're high and going higher. I think the interesting part is I'm not sure the semiconductor part of the cycle is quite over yet, because numbers are going to continue to rise there as well. So when you look at Microsoft, Alphabet, and Amazon, and Meta, each company has elevated capex, and the numbers increasing as a percentage of total revenue going into 2025. And so you want to be certain that these companies can begin to monetize that. Microsoft has begun to do so, and we're starting to see that with the other companies as well.
Scott, let's get to one of the overhangs within the tech sector at large, and that's the battle inside the Beltway. When you take a look at the DOJ's latest moves, in particular, some of the push that they're coming here for in regards to Alphabet and what they want to see happen. How should investors be approaching this space, given the fact that we're going to have a change in the White House, a change coming to the FTC, and there is so much uncertainty regarding that space?
So you have to take and I apologize for the dog in the background, but you have to take it all with a grain of salt because of the changing administration. And I think that Lena Khan is likely going to be out. And so anything that's happening now, you have to give it 3 to 6 months to really determine what the next part of this cycle is going to be. And I'm actually confident the internet companies are going to hold up quite well under the new administration.
I guess similar on the thread of regulation and the anticipated deregulation that business executives are starting to factor into their outlooks for the next year. Do you anticipate that some of the companies under your coverage can benefit from deregulation, given that so many software companies have had an acquire to grow strategy for decades at this point?
Any increase in M&A is going to improve the sector, and any reduced regulation is going to favor all the mega cap companies. And that's we think that that's going to happen over the next 2 to 4 years. So it benefits the mega caps because of reduced regulation. It benefits small mid caps because they can be acquired again. And so you start to get premium multiples built back into mid cap companies that for the past half decade just haven't existed.
Scott Devitt, Wedbush Securities Managing Director. Scott, we didn't even hear the dog barking in the background, so you've got excellent noise cancellation on your headphones.
He's still going, so
wow.
Thank you.
Having a day, having a time. Thanks so much. Appreciate it.
Bye.
Coming up, Anglo set to sell its coal business in a deal worth $3.8 billion. We're breaking down the details next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, you've got Anglo American reaching a deal with Peabody Energy to sell its steel-making coal business in a deal worth up to $3.8 billion here. Now, Peabody set to pay Anglo $2 billion upfront in cash as part of the deal. Anglo also looking to spin off its stake in Anglo American Platinum Limited and exit its nickel business as it restructures. It seems like pretty much everything was on the table here. They were looking to divest or sell off its diamond, its platinum, the steelmaking coal, and nickel businesses, really simplifying the portfolio is the effort here.
Let's take a look at Sony. It's looking to develop a mobile handheld gaming console to potentially rival that of Nintendo Switch. That's according to Bloomberg. Sony has yet to confirm any details or plans about its smaller console, but reportedly it would allow users to play PlayStation 5 games. Now, Nintendo is expected to launch a follow-up to the Switch in 2025. Of course, this could also potentially compete with the hardware, mobile hardware that we could be getting from Xbox, the maker there, Microsoft. But again, this is very early ages in this talks. It's has yet to be confirmed whether or not this will actually come to fruition. But again, good to keep in mind as we take a look out to the next several quarters.
Yeah, all right. My goodness,
Or
brings
years
back so much nostalgia here. All right, anyway, finally, Rocket Lab completing 2 launches successfully within 24 hours, setting a company record for fastest turnaround between 2 missions. KeyBank Capital Markets raising this price target for Rocket Lab to $27. That's up from $12. If we can, let's take a look at not just today's move. We're seeing on the screen, Rocket Lab shares up by about 1.4%. We'll round that off to, but over the course of this year as well, just taking a look at the activity, 344% rise in Rocket Lab that we've seen over the course of 2024 alone.
All right, well, that does it for Morning Brief. Keep it right here on Yahoo Finance. We've got Catalyst coming for you next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. Just about 30 minutes into the U.S. trading day. Let's take a look at the 3 catalysts that we're watching this hour.
First up, as investors cheer Trump's pick for Treasury Secretary, we'll break down what we can expect from Scott Bessent.
Plus, the Bitcoin rally stalling as the digital token nears the historic $100,000 mark. We'll break down the catalyst that's needed to drive further gains.
And we hone in on the outlook for cinema stocks as new releases bring in fresh crowds to the theater. All that and more ahead. Let's kick things off with the market reaction to Bessent's nomination here. I want to take a look at Treasuries because it was interesting on Friday after the announcement. We certainly saw Treasuries pulling back following that pick, and we are still seeing that as of this morning, I believe. And it's mirrored what we've been seeing in the dollar as well. Yep, there on your screen, you can see that 10-year far off that 4.5% level that it had been following the election, still moving to the downside just a bit this morning. And that does, again, mirror what we're seeing in the dollar, hitting its lowest low since November 7th, since the outcome of that election result. And we're also still seeing small caps rallying off the heels of another great week for the Russell 2000, jumping 4.5% over the last week here. So perhaps seeing a little bit of a deregulation trade playing out in the market, but a little bit more of a tempered reaction, I think, to Bessent's pick.
Yeah, Maddie, I think that's exactly right, and why we are seeing the reaction that we are seeing here this morning. You get to the fact that he will likely push through some of Trump's policies when it comes to extending the tax cuts. We know many of his priorities that President-elect Trump has laid out during his campaign trail over the last several months. But you mentioned some of the, I don't know if we want to call it extremists, but more extreme maybe viewed here by the market when it comes to Trump's potential policies. One of those, and you asked when you spoke to Scott Bessent not too long ago here at Yahoo Finance, was his thoughts on trade and tariffs and what exactly he sees. And he was very much arguing the fact that he sees that 60% threat here on Chinese imports as more of a threat in terms of a negotiating tool rather than that's likely to come to fruition. So I think the market's very much sharing that view. It's why we're looking at the S&P on track. If we were to hold today's move to the upside, the 6th straight day of gains, that would be the longest streak that we've seen since September. You're also seeing some optimism play out even in the small cap trade. You got the Russell 2000 moving to the upside here this morning. You mentioned the reaction that we're seeing in the Treasury market. So I think it's exactly that. Markets are encouraged by the fact that this will likely lend itself to some stability here in the markets. And when it comes to what the market does like, some of the tax cuts initiatives, those things like that, that's likely going to happen, likely to be a priority under Bessent.
Absolutely.
All right, well, one of the next key tests for the market rally is the Fed's preferred inflation gauge. That's PCE. It's out later this week on Wednesday. Last week, Fed Governor Michelle Bowman expressing concern that the path towards the FOMC's 2% target has stalled after core CPI and PPI both showed that prices remain a bit sticky. We want to bring in our next guest who says that President-elect Donald Trump's proposed policies could potentially cause inflation to rise, making it likely that we're closer to the end of the Fed's rate cutting cycle. Let's talk about him and ask him what he thinks. It's Jim Schmigel. He is the Chief Investment Officer at SEI. So, Jim, why do you think that?
Well, I think it's a few things. Trump's policies certainly are pro-growth. We know that. They could also be pro-inflation. But as you talked about this morning, some of the tails of that kind of tariff distribution is kind of being priced out of the market today with some pretty smart picks, including Scott being announced on late on Friday. But it's also the backdrop that we're kind of concerned about, which is, look, we have a very, very robust economy. We have a robust economy where the Fed is still adding monetary stimulus to that. And that, in our minds, is a bit of a kind of approaching a bit of a policy error from Fed policymakers themselves. But that could certainly result in inflation catching another bid here. We see inflation expectations last week at the highest levels in quite some time. We're going to get some readings on that. That's what all eyes are going to be focused on before we break for a holiday season. But that's something that we definitely have our eyes squarely on. And the market's reaction this morning, particularly from the 10-year back down to 230, that's a move that we would fade. We would expect that to kind of revisit some levels that we've seen kind of post-Fed cut, getting back closer to that 4.5 and perhaps even upwards of 4 3/4 in the first quarter of 2025.
In terms of equities, what do you think about the sort of tempered Bessent relief rally that we've seen? What does that tell you about where we're heading into year end and kind of the market reaction to these policy or personnel picks from Trump?
Yeah, I think we're in reflation. Like, we like risk assets here. We expect that to continue through the end of the year into the first quarter. And as I mentioned, the one thing that we're looking at that's still casting a bit of a long shadow is the level of rates, right? So as we get closer to 4 3/4, that's the one aspect that could pour some cold water, we think, on this risk rally. But between now and then, we think we're in reflation mode. We mentioned small caps earlier today. We like small caps. We like value. We like financials. We think we're in for a nice rally into year end and to have that continue in 2025.
Are we then set up? You mentioned the fact that we could see this tick higher in yields once again. If we do see a bit of cold water, to put it in your words, poured on this equity rally, what does that look like? Are we talking a 5% pullback? Are we talking 10% correction? I guess, how should investors be thinking about that risk?
Yeah, I think the last time that we were here, it was that 5% level that really gave the markets a bit of the jitters, and we had that nice kind of pullback in 2023. This time around, it's probably a little lower. We think the tolerance is going to be closer to 4 3/4. So if you do see that 4 3/4, that's when we would start kind of looking to perhaps diversify away, take some more defensive positions, take a little beta off the table if that's something that you've been adding more recently. Broadly, staying diversified, that's the one aspect of this relief rally that we think makes a lot of sense for end investors, to make sure that they're broadening out their risk exposures. This is not going to be a Mag 7-led, highly concentrated rally. So it's a good opportunity for investors to add to small caps, to add to value, even to add to active management. This is something that we've been trumpeting for quite some time now, using that word sort of dual meaning. But we do like active management here. We think the passive investor is highly concentrated, particularly in the United States, highly geared toward growth, obviously with the dominance of the tech sector. With the idea of broadening that out, active management is a great way of doing that as well.
Small caps have been volatile following the election, and you mentioned that we're in reflation mode right now. If we do get higher for longer off the back of that, what does that do to the small caps trade?
It's a great question. This is one I think that a lot of investors are somewhat confused about. Normally you would say to yourselves, geez, higher rates, bad for small cap. They're typically more debt reliant, and we don't disagree with that. That tends to be very, very true. If we look at what's been going on in the fixed income markets, however, there's been a lot of terming out of debt. So that maturity wall that maybe we were concerned about and maybe some others were concerned about in 2025, that really has now become a bit more of a 2026 story. So we do see a bit of runway here for small cap, even if we do believe that interest rates will be inching higher. We see a green light for small cap until, again, we get to that kind of little bit of a level above 475, which gives us a little bit of pause.
All right, Jim Schmigel, always great to have you. Thanks so much for coming in studio with us, SEI Chief Investment Officer. Let's take a look at the market headlines to start the hour, sponsored by Tasty Trade. The major averages, you are seeing gains across the board. The Dow, the S&P, and the NASDAQ starting the week in the green. You have the Dow up just about 1%. You have the S&P up just above that 6,000 level. We talked about the critical milestone there, getting back to that level here this morning. You also have the S&P up about 0.5% here in early trading. Flipping over to the bond market and some of the reaction that we're seeing play out on Wall Street, much of the optimism that you're seeing in the equity market being driven by the Treasury pick, Scott Bessent here in the Trump administration. You're also seeing that reaction play out in the bond market. You got the 10-year yield trading right around 4.3. And flipping over to the oil market, reports out this morning that Israel is nearing a truce with Hezbollah. That is putting pressure on crude prices here this morning. You've got crude off just about 2%.
And now time for some of today's trending tickers here. You'll be able to scan that QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's Trending Tickers page. First up here, Supermicro Computer extending those gains after a blockbuster week. Those shares up 16% this morning. This follows a huge surge last week of over 78%. Now this surge is coming after the company avoided being delisted from the NASDAQ. Still, SMCI remaining about 70% off of its record high that it hit back in March. Shauna, it's been fascinating to see the rally in SMCI off the back of some of its accounting issues being, I don't want to say fixed because they didn't necessarily fix them. They were just able to find an accountant who would work with them after EY said that they wouldn't. And then we also had the lack of the company getting delisted from the NASDAQ here. But we haven't necessarily seen a fundamental change from SMCI. I think that's going to be the next big thing, that if they are able to convince the market of any actual accounting changes, especially from the CEO who's also taking on their chairman role, that's going to be the next big question mark for them.
Yeah, I think here we are in kind of this wait and see mode. And we covered it at length last week talking about these new developments. We saw the optimism that swept Wall Street just in terms of the fact that they are likely to be able to avoid this delisting, but now we're waiting for the details of that. And I think that when you compare it to the levels that we were at back in March when they were at the highs, or even where we were just several months ago, we're still far away from those levels. So I think that does point to the fact that there is certainly an amount of caution surrounding this name given that uncertainty. But again, the fact that they are avoiding this delisting here from the NASDAQ was enough to move the stock and add some optimism, some hope, maybe is the best word to describe it, surrounding this name. All right, keep right here on Yahoo Finance. We got much more of your market action ahead. You're watching Catalysts. President-elect Donald Trump announcing Scott Bessent is his pick for Treasury Secretary, ending a contentious race for the cabinet role. Now, the hedge fund manager who indicated or has indicated his support for the former president's proposed policies, including tariffs and also extending tax cuts. We want to bring in Jason Furman. He's a current professor at the Harvard Kennedy School of Government and also previously served as chairman for the Council of Economic Advisors under the Obama administration. Jason, it's great to have you back here on Yahoo Finance. Just taking a look at the market's reaction to the news that developed over the weekend. It looks to be a calming signal here for investors. I'm curious what you make of the pick and what you think the implications of Bessent there as Treasury Secretary are going to be for the economy.
Look, I think that Bessent was a good pick. He's mainstream. He knows a lot about the world of finance. I hope he learns a lot about the world of public policy, which is one he hasn't been steeped in, but I'm sure he can do that. The bigger issue, though, is that the main calls on the economy are going to be President Trump's. President Trump sent us a bit of signal about how he'd make those calls with this pick, but he hasn't sent us any signals that he's given up on, large across-the-board tariffs. And until I hear that, I'm going to be nervous.
Well, talk to me about what would give you clarity then, Jason, because it seems like there's this question mark right now about kind of the rivals that Trump has put in his personnel surrounding him, that they don't all necessarily agree about one central economic thesis. So when will you and the broader market have that clarity, and what might that look like?
I think we'll get it over the next 6 months. And what it depends on is, are tariffs a good thing in and of themselves? A way to raise money from other countries, which is, by the way, false? Or do they think tariffs are a negotiating tactic and they're willing to get something in exchange for not doing them? If it's that second path, the negotiating tactic, and that's what Scott Bessent has emphasized in some of his public comments, then hopefully they're willing to take a pretty small win, declare victory, and keep the focus on China, which they should. But we don't need tariffs on Australia, New Zealand, and Germany. In fact, I don't even know what wins that we want from those countries.
So, Jason, it sounds like you're viewing him as almost as a safe pick here for not only the markets, but also for the economy under Trump.
Yeah, he's the safest pick that was on that list. Well, there were other safe picks on the list. Anyway, he's a safe pick. He knows what he's doing. If we hit financial problems, I think he would be able to figure out how to work together with the Fed and handle them. He's a responsible adult. But again, the Treasury Secretary does not make policy. The president makes policy. And this is a small hint about how the president might make policy, but only a small one. And in fact, Bessent only got this job when he said much more pro-tariff things than, my hope is that he actually thinks and believes.
I'm curious on that wavelength there, just the strategy of this pick. I guess, what do you think, Jason, this tells us about some of the future picks, NEC chairs, some of the other key names or key policymakers that have not been named just yet? Does this show maybe a drift or a break than what we've seen from some of the other nominations so far under the incoming Trump administration?
Look, in the first Trump term, you saw a lot of heterogeneity on the economic team. They range from protectionists like Peter Navarro to, free traders like Gary Cohn. And I expect you'll see something like that now. The president, in some areas, doesn't mind hearing discussion and debate, and economics is one of those areas. National security, law enforcement, health, there you're seeing much more united, consistent picks to push the things in the direction that he wants to push it in. On the economy, I expect a lot of push and pull within the administration over these topics.
It's interesting because the markets thought 4 years ago, for example, that Yellen was going to moderate some of Biden's inflationary policies, and that turned out to be harder than anticipated. Do you think the market's ahead of itself in terms of how much power Bessent is going to potentially have to curb any inflationary policies?
Yeah, I think it's ahead of itself. And by the way, on inflation, I just haven't seen anything from this administration that is anything other than a large fiscal expansion. Yes, they have this Department of Government Efficiency. I'm skeptical it's going to come up with a whole lot in the way of savings, but that'll be massively outweighed whatever they do with tax cuts. And I expect defense spending increases that, by the way, I think we need in this country as well. So, Scott Bessent could end up really having to grapple with the fiscal situation with rising interest rates over time, even if the bond market was momentarily happy today.
Well, on the topic of those rising interest rates, we spoke with Scott Bessent back in July about Fed independence. He had previously floated the idea of nominating a replacement shadow Fed chair that would potentially dilute Fed Chair Powell's power before Powell's term is up. Here's what Bessent had to say about that.
I think President Trump understands that, what anchors inflation expectations is the credibility of the Federal Reserve. I think Jerome Powell has done an extremely poor job, but I don't think it's to anybody's advantage to fire him. I think, President Trump's going to make his opinion known, but, I would not advocate for replacing Jerome Powell before the end of his term.
So Jason, sounds like Powell, he's not going to be out, but if there is this shadow Fed chair in the form of Kevin Warsh, for example, what would that potentially do to the Fed, and how are you thinking about that?
Yeah, I mean, Besant also walked away from that shadow Fed chair idea. It's a terrible idea. And, and I hope we don't see it. Again, the choices about the Fed are going to be made by the president. If he's tweeting things like Jay Powell is worse than President Xi of China, do I think that hurts the economy and hurts inflation? Maybe not. Would I advise a president that that's a good thing to do? Absolutely not. And so I expect at a minimum we're going to hear a bunch of unnecessary noise. But what happens if inflation is resurgent because of the tariffs? They raise interest rates by a quarter point. Are we going to continue to see the restraint they're talking about now? I'm not sure.
Jason, what is the biggest risk or the two biggest risks of a shadow Fed chair that the market needs to know?
The biggest risk is much of how the Fed operates is by setting expectations for what it'll do in the future. And any uncertainty and unpredictability just increases volatility. It can deter investment. And ultimately, as Besant correctly said in that clip you showed, the Fed's credibility is the cheapest way to bring inflation down and keep inflation low. If it loses that credibility, inflation will start to drift up, and it would be very painful to reverse it.
Jason, while we have you, I want to switch gears a bit and talk about an op-ed that you wrote in the Journal about how to regulate AI without stifling innovation. And regulation is a key part of the incoming administration's policy agenda here. What do you think that regulation should and could look like?
Yeah, so first of all, the goal of the regulation should be to get more AI. This is not something we should be afraid of. We should be afraid of not having enough of it to give us the innovation we need for education, for wages, for medical research, et cetera. Don't think we should have a single super regulator. Just let each domain, for cars, is the car safe or unsafe? That's who should be regulating it, not some AI super regulator. And I also think, and I hope this administration does this, we need to get rid of some of the obstacles that stand in the way of AI, things that, for example, make it harder to set up nuclear power plants that they'll need to create, the type of clean energy to fuel their data centers.
Jason, one of the things that you brought up in this op-ed that stuck out to me is not every problem caused by AI can be solved by regulating AI. Talk to me a little bit more about what you mean by that.
Yeah, let's say AI is taking jobs. I don't believe that that's the central case, but it might be the case. You don't want to reprogram the AI not to take people's jobs. Taking people's jobs is the process of efficiency as the economy moves forward. But what you do want is new training programs, new education programs, maybe tax benefits for people, et cetera. So it's non-AI solutions to that challenge that's created by AI. That would be one example.
I also thought it was interesting, especially given the rally that we've seen in small caps over the last week, Jason, what you mentioned about little tech needing a little bit of help from regulators. Talk to me more about that.
Yeah, I mean, there's been ideas floating around, and Sam Altman has floated this idea that the AI super regulator should certify you as to whether you're allowed to have a large language model. And who could pass that certification? OpenAI could pass that certification, so could Anthropic, so could Alphabet. But a lot of smaller companies would have a harder time with it. So we do not want to create regulations that make it harder for small businesses to compete in this space. Now, right now, this is an extremely expensive space that's dominated by data and compute, huge barrier to entry. But we may start having some innovation in the form of algorithms and smaller businesses that can grow, and certainly smaller businesses that can build on top of the larger fundamental models. Don't want any regulation to get in the way of that.
So, Jason, I'm curious then, I guess, how should regulation then be approached? Because at one end of the spectrum, you want it to be, I guess, addressed quickly, just given some of the risks associated with this. But on the other end, and you pointed out this a number of times within this op-ed, there is a strong reason to proceed very cautiously on this.
Yeah, so I think you're just regulating outcomes. Is a medical device safe or unsafe? Is a car safe or unsafe? Is something compliant with the SEC rules on trading? And that's not, and you apply that the same whether it's AI or not AI. So you're regulating basically based on outcomes, based on accepted concepts of safety, rather than treating this in some new and different and scary way.
All right, Jason, we got to leave it there. Always appreciate you joining us here on Yahoo Finance. Thank you so much. That was Jason Furman. He is a professor at the Harvard Kennedy School of Government, previously serving as chairman for the Council of Economic Advisors. Coming up here, we're taking a look at today's trending tickers. We'll get you the news behind those moves next, right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It all can be done at Yahoo Finance's trending tickers page. We want to take a look at CrowdStrike. It's set to report third quarter results tomorrow. Now the company is expected to report a hit that's going to include the company's global IT outage back over the summer. That was in July. It was triggered by one of its software updates, of course, sending ripple effects globally. Investors will also be looking at the cybersecurity provider's plans to increase subscribers. And I think subscriber count is really going to be critical within this report, because right after the outage, you and I spoke to so many analysts about CrowdStrike, just what exactly that backlash could potentially look like, what the blowback is going to be, whether or not they were going to have a tough time renewing existing customers, how tough the selling process was going to be in order to attain new customers. This is going to be the first real glimpse that we're going to get at this and some of the fallout. So I think as we move beyond what the financial implications obviously were when this happened happened back over the summer. I think now we're going to start to get a good look as to what some of those ripple effects would be and how long lasting it could potentially be here for CrowdStrike.
Especially given that we know the street at least is expecting revenue to fall by about a third in this print, given the impact of that strike, not only like you mentioned, Shauna, in terms of getting in new customers, but also retaining existing customers. We're expecting to see the lowest level, the biggest decline rather in net new recurring revenue since the company went public back in 2019 as they struggle to add customers and retain existing ones. I think they have a really tall order of proving their cybersecurity offerings and just their general offerings, because we know that the outage itself was not a cybersecurity event, but I think it led to broader questions about the validity of the company's offerings, and that's why they're struggling in terms of customer addition and retention.
And also just how reliant so many companies are on one cybersecurity company, right? Just in terms of, we saw obviously the impact at Delta clearly was arguably the most impacted by this outage. And I think that's raised concern just about some of the providers and how exactly these companies are approaching that to avoid something like this from happening again too, which could obviously have implications. You mentioned the customer base, but implications there as well.
Right, because now if you're Delta, you don't want your investors worried about your cybersecurity challenges and your networking challenges there as well. All right, well, we're also looking ahead to HP and Dell, both reporting tomorrow. All eyes on the impact of AI on the PC side of things. Yahoo Finance's executive editor Brian Sozzi, he spoke with Dell's CEO Michael Dell back in September about that broader demand picture. Take a listen.
But the macro picture here is very, very clear, and that is that there's enormous demand. It's growing. It's expanding out from the hyperscalers to the service providers, to enterprise, to commercial, to sovereign AI, to embedded AI, to the edge, to retail, to manufacturing, to your PC, to here, there, and everywhere. And we think it's a great opportunity over the next several years.
So Dell's quarterly sales growth, it could reach a 3-year high of 10% on this earnings print, according to the street. They're expecting service revenue gains while the product segment continues to slow. So that's what's going to be really interesting to see, whether or not we see any movement in that product division, because that would also be indicative of something that we could see in HP and some other PC providers as well.
Yeah, exactly. I think one of the things that's most interesting to me is how we certainly have seen this shift among Wall Street and their view right now of Dell and even HP, just in terms of comparing it to where we were several quarters ago. And they seem very optimistic that they're going to continue here to carve out more of a market share when it comes to AI adoption and what exactly some of that demand is going to do for their business going forward. On the heels of the NVIDIA results not too long ago, we got a number of analysts coming out saying how positive they were on these upcoming results because of that demand that we simply saw at NVIDIA. Evercore was one of those shops that came out saying that sustained demand for Hopper products is a positive sign for Dell. They went on to talk about HPE, not HPQ, but also went on to talk about the fact that given the fears of pocket of digestion between Hopper to Blackwell transition, so opening an opportunity there for some of the other names that clearly have a much smaller market share. But again, maybe it could lend some headway there and hopefully maybe regain some of that market share going forward, or maybe show the potential and what that could look like for the quarters to come.
Absolutely.
Let's take a look at a big retailer here out this morning with some news that's grabbing headlines. Macy's delaying its third quarter earnings report following an investigation that revealed an employee hid tens of millions of dollars of expenses. Yahoo Finance's Brooke DePalma joining us now. And Brooke, we're looking at shares off just about 3% here this morning.
Yeah, good morning to you both. Investors really trying to digest this accounting expense as well as preliminary results announced by Macy's this morning. They were supposed to be out on Tuesday morning and now will be reported by December 11th. But here's what we know. We know that this accounting expense was isolated to one employee responsible for small package delivery expense accounting over the course of 3 years. This happened from Q4 2021 to the most recent fiscal quarter ending on November 2nd, 2021 to the most recent fiscal quarter ending November 2nd, 2024. Now, this one employee intentionally made accounting errors, hiding anywhere from $132 to $154 million. Now, experts telling me this morning that the act was disappointing, but it will not leave a major dent on Macy's. If you take into consideration, Macy's has over $8 billion a year in operating expenses. So even if to say this was roughly $50 million per year underreported over the last 3 years, that's pretty immaterial for Macy's, accounting for just about 1% or less than of Macy's annual expenses. It's important to note here that this employee is no longer with Macy's. The company shared this morning in the release.
And Brooke, I know that we're still getting details in here, but I just don't understand this. I don't understand the benefit to the employee. I don't really understand why you would want to do this. I heard someone this morning saying maybe it was to get a bigger budget in the following years, but it seems kind of drastic. What are your sources telling you?
Yeah, some sources this morning telling me that it was personal or professional greed. So perhaps the employee had something that had financial setback in his life. Some even alluding to sometimes it's happening with gambling or other sort of issues that this employee could have been facing. And then to offset that, they, conducted this at Macy's to offset that. And others saying that this could have been professional greed in order to perhaps get an promotion, make this look better for the employee. Of course, this is still an internal investigation. Some even calling that former Macy's executives should come back and conduct this probe and then use their expertise they have formerly, especially as we know Macy's has faced that activist investor in this past year as well.
Really good point.
Brooke, we also, so they delayed their release, but we did get a good early look at some of the trends that we are seeing within Macy's. What was your big takeaway there?
Yeah, investors really trying to figure out what they should make of both this accounting expense and the preliminary results, largely in line with what expectations were. We know that net sales came in at $4.74 billion versus $4.75 billion being the expectation. Adjusted earnings we didn't get yet, but the street does expect that to fall by 1 cent. Same-store sales coming in a bit higher, although a decline of 1.3%. And this all comes as they're doing that bold new chapter strategy, really trying to embrace this idea of investing in the first 50 stores with new visual displays, more staffing, more assortment. And in those first 50 stores that they're investing in, we did see same-store sales grow for the third consecutive quarter at those first 50 stores, up 1.9%. Tony Spring, Macy's CEO and chairman, telling Yahoo Finance that it's this idea of a golden equation that they're seeing in these stores. They saw a little bit more traffic, a little bit more conversion, a better average order value. But however, same-store sales still in decline. So Wall Street really trying to make what they can with these preliminary results.
Yeah, a lot to digest, especially given the accounting errors as well. Brooke, thank you so much for breaking it down for us and giving us a guide. Really appreciate it as always. Thank you. Coming up here, Bitcoin's climb to $100,000, still stalling here. We're going to talk the outlook for crypto policy next, right here on Catalysts. Bitcoin's post-election march toward $100,000 stalling here. The cryptocurrency now ticking lower here, just above the 95,500 mark, but still moving to the downside this morning. With President-elect Donald Trump tapping Scott Bessent as his pick for Treasury Secretary, what can investors expect for the future of regulation in the crypto space? Joining us to discuss, we've got Don Friedman. He's the president of the Digital Assets Council of Financial Professionals. Don, it's great to speak with you. So talk to me about this move we're seeing to the downside here. What do you make of that move? And do you think it'll correct itself to give the crypto enthusiasts out there that $100,000 level by the time they're sitting down for Thanksgiving dinner?
I really don't think it's anything to worry about. Think about several years ago, we had this discussion about 20,000. It went lower. Then we had this discussion earlier this year at 73,000. And now we're having this discussion again at 100,000. So we look at this as a phenomenal opportunity to dollar cost average your way in. As you can imagine, people have FOMO, fear of missing out. And that makes people nervous. When you dollar cost average, you're robotic, it's mechanic, you're buying it on a regular basis. And that way you're in a good spot for the long term.
Well, Don, then how should investors, I guess, when you talk about getting in a good spot for the long term, what does that long-term potential look like in your view?
Again, we try and stay away from predictions. Most times people are wrong on that. Again, when you dollar cost average, that's the way to go. The discussions that we're having more with advisors is more about, like I said, dollar cost averaging, rebalancing if it goes up. And then in a year like 2022, if it does go down, you have the opportunity to take advantage of the tax loss harvest. So don't focus on predictions, focus on dollar cost averaging and getting in on a regular basis.
Getting in on a regular basis sort of reminds me of what we're seeing from Michael Saylor over at MicroStrategy, continuing to get in on a regular basis. He says he likes to buy the highs, but is that a strategy that retail investors who don't necessarily have the balance sheet he has should copy?
Well, obviously, they're buying in a much smaller amount. But the interesting thing you bring about Michael Saylor is he just bought it around 88, 89,000. So as an average investor, think about, like, do we think we're smarter than Michael Saylor? I would say not. So if he's buying at 88, 89, it's probably okay, again, for a retail investor as long as you dollar cost average.
Don, I guess just more of a macro level here for investors. How should they be viewing the incoming Trump administration, some of the commentary that we've gotten from some of his top picks regarding crypto, even Trump himself, the reversal there, not so much putting a number in terms of how big of a catalyst it's going to be here for Bitcoin specifically, but I guess how much more bullish could this potentially make the industry, financial industry overall in terms of that opportunity within crypto?
Yeah, that's a great question. So one of the things about Bitcoin specifically is there's a limited number of coins. There's only 21 million. So that bodes well for the asset class. In terms of what's happening politically, you've got a Republican president. You've now got Republicans winning both chambers of Congress. So that all bodes very favorably. You've got Tim Scott, who said at Bitcoin 2024 that if Republicans take the Senate, that as Senate Banking Committee chair, that he would be in favor of a strategic Bitcoin reserve. You've got Senator Lummis, who has put forth a Bitcoin bill to buy 1 million Bitcoin. So there's a lot of positive energy moving in terms of the future of Bitcoin. And why that's so important is because institutions want regulatory clarity in order for them to access the asset class. And as we've seen to this point with Gensler, it's been rule by enforcement, which is not good for anybody. The crypto industry wants to be regulated. They just need to know the rules. And now with Republicans sweeping, hopefully there'll be far greater clarity sometime in 2025, which is very, very good for institutions because that's what they need.
You mentioned the SEC chair, so I'm curious, is there a pick that could derail the crypto rally that we've seen? Is there any risk of that in your view?
I think it's highly unlikely. He's going to choose somebody that's probably pro-crypto, and therefore I think it's going to add to that ultimate regulatory clarity, which is badly needed in the space.
Don, going back to what you just said a moment ago and talking about the U.S. Bitcoin Reserve, you mentioned Senator Lummis, you mentioned some of the initiatives there that we have seen unfold from inside Washington. I'm curious just to get, or what you've been hearing from inside the industry, just how optimistic the odds of actually creating a Bitcoin Reserve.
I mean, again, that's a tough question. There's obviously bulls in the camp in terms of that's going to happen. Already the government owns over 200,000 Bitcoin, which Trump says they will not sell. Trump wants the United States to be the crypto capital of the world. So all this bodes very favorably for the asset class. So again, I think stay away from price predictions and focus on dollar cost averaging. And I think you'll be pleased in the long run.
All right, Don Friedman, Digital Assets Council of Financial Professionals President. Thanks so much.
Thank you.
Coming up, we're taking a look at how cinema stocks are performing after the Glicked phenomenon sent audiences to theaters over the weekend. We're going to explain that and talk about what exactly we're seeing play out inside Hollywood. That's coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to living not so fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capsule Gains, where for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
AMC getting a boost this morning after a strong weekend at the box office. Wicked and Gladiator 2 combined for a total gross of $170 million. Wicked alone making $114 million, making it the top performing Broadway musical adaptation in Hollywood history. Here to break down what this means for cinema stocks in the broader market, we've got Gitesh Pandya. He's founder and editor of Box Office Guru. Gitesh, thank you so much for coming in studio with us. So I feel like every time we have the Glickids, the Barbenheimers, there's this idea that we're so back for these cinema stocks. But it hasn't happened yet. AMC, they're still down 20% on the year. So what is it going to take? Was this weekend a step in the right direction?
It's absolutely a step in the right direction. This is what the box office needed this year. The movie industry over the last few years has had two major disruptions. You had the pandemic shutting all theaters down, and then as things are getting back to normal, you had the double strikes last year, the writers, the actors, and that caused massive delays in the pipeline of product. So this year in 2024, we had many months with hardly any, big blockbuster films. But now, as we enter the fourth quarter and going into 2025, the outlook is very good. For Thanksgiving, we have two massive films opening this past weekend, which will continue into the rest of the month. And Glickid, as we call it, is never expected to be like Barbenheimer at that level. It's about 30% less in sales, which is completely normal, completely fine. But Wicked did fantastic. Gladiator 2 did really well. The reviews are good. The audience metrics are fantastic. And people are coming out and spending. And that leads into the rest of the holiday season. People are seeing trailers, posters, all of the in-theater product to hopefully come back for the rest of the year to end off 2024 with a bang.
So it sounds like you think Moana 2 is just going to be an absolute home run then for Disney. Is that fair?
Grand slam, I would say.
Okay.
Definitely. That one is a huge brand. Disney owns Thanksgiving almost every year. Their big sequels, big brands come out. Moana is one of the most successful original animated films Disney has had in the last 10, 15 years. It's lived on through streaming and merchandise and everything else. There's a new generation of kids who want to see Moana 2. There's the old generation of kids. So that one is going to do gangbusters over the 5-day holiday season. And it'll probably continue into December and maybe even hold on to the Christmas season as well. But that is an absolute guaranteed hit. And then you have the second weekends of Gladiator and Wicked. So we're looking at probably the biggest Thanksgiving box office in over a decade.
It makes me think about Inside Out 2, and I believe it was the second best performing movie of the year. Could
the biggest one. It's
right,
the biggest one.
Okay. Could Moana kick it off that list?
Well, the pre-sales are almost at the same level as Inside Out 2. That was a Father's Day weekend, beginning of the summer holiday time, kids getting off of school. Right now with Thanksgiving, you have a couple of days off of school, then right back into school after that. So the midweek grosses, Monday to Thursday, won't be the same as for Inside Out 2, which was during summer vacation. So, we'll see how good it is if it can last that long. Inside Out 2 was a fantastic film. The legs were great on that one. The other kids' movies were not as good. And then Deadpool and Wolverine, another Disney movie, is the #2 movie of the year. So the same studio has those two films. But now you've got Paramount and you've got Universal this weekend, sort of giving us a mix.
Gitesh, I'm curious just to get your thought on the sequels and success there, because Disney was long criticized that they were coming out way too many sequels, that people were sick of them. It clearly wasn't a strategy that's working. It seems like, though, it is working in some regards. I guess explain that phenomenon to me and what maybe that signals about the future and success of some of these theatrical releases that we'll see going into 2025.
Right. Well, I would say action and words can be completely opposite. And so when it comes to the words, what do people say? Too many sequels, too many brands. I don't want to see this over and over again. But you look at the action, the box office sales. What are people spending money on? The sequels rule the day. I think maybe 9 of the top 10 movies this year are sequels. That's pretty standard over the last several years. The sequels work. And that's why the studios are going to make over and over again. If you look at Wicked this weekend, Part 2 is already set for the same weekend next year. So this is a big brand that's cut into two pieces, and it's going to make so much money next time also. So Disney is really leading the way. They have all these silos. They have Marvel, they have Pixar, they have Disney Animation. They have Lion King, the Mufasa movie coming up for Christmas time. Sort of a prequel, but still kind of like a sequel. So people talk about these things not working, but if you look at the balance sheet, they do work. And so I expect all these studios to continue with all their sequels moving forward.
Do you expect to see more movie musicals moving forward as well?
Well, I don't think that Wicked's success necessarily translates to other properties becoming successful musical. John Chu is the director here. He conceptualized this a long time ago into this two-part film. If you notice the marketing, they dropped the part one. They just called it Wicked, but it's actually for the first of two parts. And it was a big risk. The sequels obviously have a built-in audience. Sometimes these properties turned into movies don't always work. Sometimes they flop, big budget gambles. Sometimes they don't work. Wicked did work really well, and the audience reactions are fantastic. So part two should do really well. But I would say, I would hesitate a little bit about other properties from Broadway being turned into musicals, because most of them don't do anywhere close to this level of business. It's kind of a unique situation here, I think.
What are we seeing just in terms of how many people are actually going to the movie theaters, whether or not they're full again, whether or not that's a trend that is going to stick at this point? I'm curious from the number, and it was probably countless movies that you have seen this year. What are some of the trends that you're noticing that either makes you optimistic or question whether or not this is a trend that's here to stay?
Well, I mean, obviously the brands are working, the bigger superhero films and action movies and all of that. And next year already has a lineup of Jurassic World and Mission Impossible and things like that, Captain America. So the brands are definitely working. But I do have a little bit of faith in some of the original films. Once in a while they come out, especially if something has great reviews, maybe some Oscar buzz. Those can work sometimes at the box office. There was a movie in, July? It Ends With Us, based on a book and not a sequel. Again, it could work, maybe it wouldn't work, but that one did gangbusters, despite some controversy that was around it and some of the chatter around that. But as far as ticket sales go here and around the world, you're talking about 350 million worldwide for a movie which is not a superhero film, not a special effects expensive movie. So there are examples like that where things can come out and grab an audience. But overall, the attendance numbers, AMC, of course, is doing well. But one thing they didn't mention was that the Thanksgiving marketplace has been pretty weak the last 10 years. That's one of the reasons why, by comparison, it looks really great right now. But these movies are coming out, and they'll keep coming out until the rest of the year.
All right, Gitesh, great to have you, especially here on set. Thanks so much.
Yeah, thank you.
That does it for Catalyst here today. Keep it right here. You've got Wealth. Bradley Smith has you for the next hour. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, a look at the markets in 2024. We'll reveal the best and worst performing stocks and sectors as we head into 2025. And a deep dive into the housing market. We'll take a look at migration trends across the U.S. and talk about why so many people decided to move to the South last year. Plus, Warren Buffett is converting a bunch of his Class A Berkshire shares into Class B in order to give the shares to some family foundations. We'll bring you the tips from the billionaire investor himself on how to transfer generational wealth. All that and much more during today's show. But first, let's take a look at some of the market action. We are 90 minutes into the trading day. Stocks right now, the U.S. major averages that you're seeing on your screen, up across the board, led right now by the Dow Jones Industrial Average on a percentage and point basis. It's up by about 0.9%, as you see there. This as we kick off the holiday-shortened trading week. Joining me now, we've got Brian Vendig, who is the MJP Wealth Advisors Chief Investment Officer. Great to have you back on the program with us. You say your main message for investors right now who may be, kicking around some ideas even over the dinner table come Thanksgiving is to stay diversified. So that is what my plate is going to look like come Thursday. But what about on a portfolio basis? What does that look like?
Thanks, Brad. Great to see you as well. I think, look, it's classic to say stay diversified, but I think it's because we've seen over the course of the year a very small handful of stocks contribute significantly to the overall market returns. And it's only really been over the last half of the year have we seen some broadening out in some other traditional value sectors outside of mega cap tech. And so I think as we look into next year and recognizing that there is a little bit of a push-pull between the mosaic of some different policies that could come out under the new administration, I want to make sure that investors are not overpaying for growth and making sure that they're looking at other areas outside of mega cap tech that have growing earnings and lower valuations. And again, making sure that we're staying balanced from a risk point of view.
And so is that risk on? And if so, in what areas of the market right now would you be identifying those opportunities?
Well, when we look at earnings forecasts for next year, Brad, we definitely are having a more risk-on posture because earnings are expected to grow over 10% year over year. And again, tax cuts, deregulation, and obviously if some of these policy decisions don't go to extremes, I think that is still positive for overall stock market. And from areas that we're saying investors should be focusing on, look at industrials, look at cyclical sectors of the economy that are supported by the expectations of interest rates being cut over the next year or so from the Fed. And at the same point in time, I'm not saying abandon tech, but I'm just saying being very selective on where you're going to invest in the space, because when troubled waters and concerns start to impact the markets, it's usually those sectors that have run up the most are the ones that are going to sell down the most and leave the markets more into a correction. So again, just being sensitive to risk allocation and posture as we kind of move through the next couple of months, which still are going to be very uncertain as some of these policy decisions come out from Washington.
We've seen some of the overall outlooks from banks and the largest institutions start to come out over the past several days now, and we're seeing perhaps this kind of average out of about 6,600 as some of the big calls that have been out there for the street. What are you anticipating in terms of the S&P growth factor and what's really going to drive that narrative for a lot of potential investors out there who are looking for just that next major theme that this market can really propel based on?
Yeah, I mean, I think the themes going into next year are going to be, again, supported by, is the economy going to continue to chug along with expectations of growth anywhere between 2 and 3% next year? Is the consumer still going to be healthy and spending, even though consumer has been selective on price? I don't think that theme is going to change anytime soon. And making sure that the labor market is stable so wages are exceeding overall inflation numbers for next year. And granted, earnings, as I said before, is a real support for the overall market and valuations that are getting to those S&P projections for next year. Obviously, the biggest risk to all that are policy mistakes. Policy mistakes that can come from the Fed regarding timing of rate cuts and policy decisions there. And plus, as I said, the extreme examples of tariffs and immigration policies, which could be a negative to the economy as compared to deregulation, lower taxes, and other ways to balance spending, moving forward.
How are you balancing some of the mega cap tech versus small caps right now?
Well, we are constructive on both in the sense that, in our portfolios, we have a foot in the direction of growth, and the AI trend is still going to be one that plays out over the next 5 to 7 years. If you listen to some of the comments that were made last week on NVIDIA's earnings call, that definitely supports that those trends are still in place. However, on the small cap side, the fact that we do have a belief that the economy is not moving into a recession, and the lower interest environment should help smaller caps, especially being domestically focused companies. We still like that as an opportunity to get some upsized growth over the course of the next 12 months, because they really have been quite a lagger from an asset class perspective over the past 10 years.
To what extent does a diversified portfolio, where we started off the conversation and have continued the thread, to what extent does that also contain crypto?
Well, look, I think crypto is something that we've seen with, coming off the election and the animal spirits being released because of the expectation of lower regulations, more adoption, especially, with changes in leadership, as we've seen in the regulatory space and some of Trump's appointments. I think crypto, for those that want to speculate, because I still believe it is a speculative investment, it might be about 1 to 3% of your overall liquid portfolio. And that's a conversation that I think an investor should have with their advisors, as well as research for themselves before just jumping in because of this momentum trade that we've seen in the short term. But the other part, Brad, that I just want to hit on that real quick on diversification is don't forget about bonds. We spent a lot of time talking about equities and crypto, but with interest rates coming down, bond prices going up, and getting some really compelling tax equivalent yields, especially in the muni space, those could be some things to talk about around the dining room table on Thanksgiving as well, Brad.
Brian Vendick, who is the MJP Wealth Advisors Chief Investment Officer. Brian, great to have you here. Thanks for taking the time this morning.
Thank you, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We're heading into 2025 tracking the best performing stocks and the sectors year to date. And so let's kick it off with some of the best performing stocks in the S&P 500. The top 3 are all considered AI plays. In the third place, we've got NVIDIA up 177% so far this year. I know what you're thinking. How can this be in third place? Well, Palantir, that has entered the chat. It's up 281% this year. And then the best performing stock so far this year of the S&P 500 stocks, Vistra, this electricity giant is the best performing one. And then let's take a look at the other side of the spectrum here. The worst performing stocks in the S&P 500, some familiar names here. Dollar Tree down 50%. You've also got Moderna, which hasn't successfully shifted away fully from its COVID vaccine, is down 54%. And then the worst performer, you've got WBA, Walgreens Boots Alliance, that is down 65%. Now, let's take a look at some market performance from a sector POV. The top 3 best performing S&P 500 sectors to this point, year to date in 2024, have been financials, technology, and communication services. And utilities, actually, that is now ousting here tech. So, all this considered, where are the worst performers? Real estate, materials, and healthcare. Those have been your worst performers so far. However, they are still positive on the year. Just bringing up the caboose. Well, RFK Jr.'s nomination to lead the Department of the Health and Human Services Department could impact weight loss drug makers and the food industry as a whole. Yahoo Finance's Josh Lipton joins us now with a closer look at this one. Josh, what have we discovered? What does it sound like is being the prioritization here?
All right, Brad. So listen, here's what we know. President-elect Donald Trump has made it very clear he wants Robert F. Kennedy Jr. to run our Department of Health and Human Services. And that means Kennedy would have a huge set of responsibilities overseeing the FDA, CDC, and the head of the Centers for Medicare and Medicaid Services. Kennedy is a well-known skeptic of the pharmaceutical industry and our country's big food industry. Of course, we don't know if the Senate will indeed confirm Kennedy, and even if they do, what his priorities would be. But already, investors and analysts on Wall Street are trying to game out the potential effects. It could be far and wide. Now, for the purposes of this discussion, let's focus on two areas. One, GLP-1s. Kennedy is skeptical of these medicines, telling Fox News in a discussion about Ozempic, they're counting on selling it to Americans because we're so stupid and so addicted to drugs. That could have consequences for market leaders like Eli Lilly and Novo Nordisk. So what could Kennedy do about this? For example, could he try and derail efforts by GLP-1 makers to gain Medicare coverage? Analysts say that is a possibility.
As the secretary, he would. I mean, the Congress has to pass a law to allow Medicare to cover it specifically for obesity. The president could veto that law if the law doesn't get done before January 20th, so he could advise the president to veto that going forward. The thing with RFK Jr., I think, if we step back, is he has a lot of different views, right? So right now, the danger for investors is there may be 100 different things he can do. When you're secretary, your time gets sucked up with a wide variety of other stuff. I know that. I was at HHS. I saw that happen to secretaries with extensive executive branch experience and executive management experience, neither of which RFK Jr. has much of at this point. And even they had a hard time getting their stuff done. So out of 100 things he says, he may get 2, 3, 4 things across the finish line. It's being able to identify what those 2, 3, 4 things are. I think GLP-1s are one of those things he's talking about. But there's probably others that are more likely where he could have a significant impact outside the GLP-1 space. So the sell-off we've seen might be a little bit overdone compared to what the reality could end up at the end of the day.
Now, another area Kennedy is passionate about, what we eat. He is vocal about prioritizing the regulation of ultra-processed foods, for instance. Now, that could prove to be a challenge for some companies, but a possible tailwind for others. Wells Fargo analyst Edward Kelly tells clients a knock-on effect of RFK could be expansion of an already strong trend toward healthy eating, driving increased consumption of higher-margin fresh, natural, and organic products. That's another reason, in his opinion, to own names like Kroger and Albertsons, as well as Sprouts Farmers Market, though he says valuation is a hurdle for that one. Meanwhile, value players like Walmart, Costco, and BJ's could also benefit, he argues, but might need additional product repositioning to truly align with the RFK healthy eating theme. Brad, back to you.
All right, thanks so much, Josh, for breaking that down. A lot to track with all of those names going forward from here. Appreciate it. Switching gears. Billionaire investor Warren Buffett is not immune from the great wealth transfer and gave investors a peek at how he thinks about his own family wealth dynamics. Buffett announcing he will convert 1,600 Class A Berkshire shares into 2.4 million Class B shares. Those shares will go to 4 family foundations as part of a pledge he made in 2006 to reduce his shareholdings over time via those donations. Shares of Class B Berkshire trading above $480, making the value of the donation a little over $1 billion. Buffett says that upon his death, his 3 children will have full responsibility for gradually distributing all of his Berkshire Hathaway holdings. Here are 4 key takeaways or pieces of advice from Buffett around his own wealth transfer and how it can relate to you. First up, giving money to your kids. He says upon his first wife Susan's death, she left $10 million to each of their 3 children. He said that that figure reflects their belief that hugely wealthy parents should leave their children enough so that they can do anything, but not enough so that they can do nothing. 2, having a backup plan to deploy his assets. Now, his children are now ages 71, 69, and 66. So Buffett's massive wealth transfer may take longer to deploy than his children live. He says, quote, tomorrow's decisions are likely to be better made by 3 live and well-directed brains than a dead hand. As a result, he has appointed 3 potential successor trustees who he and his kids and those kids and their trust are younger. Third up here, making sure that his kids say no to certain monetary requests. He says, quote, those who can distribute huge sums are forever regarded as targets of opportunity. This unpleasant reality becomes even more so with the territory here. Therefore, Buffett has implemented requirements that all family foundation actions require a unanimous vote. And last, make sure your kids understand your will. Buffett suggests parents should have their mature children read their will before they sign it in order to make sure children understand the decisions and responsibilities that may come to them in the event of their parents' death or deaths. $84 trillion is expected to change hands by 2025, according to Cerulli Associates in the Great Wealth Transfer. And whether it's Buffett you listen to or a financial advisor, you need to make sure that you're planning for you and your family's financial future. Coming up on the other side, a pulse on the housing market. We're going to discuss migration trends within the U.S. with an expert from the National Association of Realtors. Plus, health is wealth. We're talking to the CEO of wearables company Aura about consumer demand. All that and much more. Existing home sales improved in all 4 major U.S. regions in October, and the National Association of Realtors chief economist Lawrence Yun says the worst of the downturn in home sales could be over. But mortgage rates are still high, the 30-year fixed approaching 7%. Median existing home prices right now up 4% from a year ago. Yun says additional inventory and more home building activity will help price increases moderate next year. Now, the NAR is out with a new report highlighting migration trends within the U.S. in 2023. As we're here to talk about the report and the trends that we might see in 2025, we've got Matt Christopherson, who is the Director of Business and Consumer Research at the National Association of Realtors. Okay, so what have we seen within the most recent data really tracking some of the migration that we've seen among the states?
Yeah, so hi, Brad. Thanks for having me. And the report really shows the high priority buyers are placing on being close to family and friends, but also finding affordable opportunities. They're really finding places where they can get more home for the money.
And so how have they been able to alleviate some of the pressure, and what were some of the top reasons that they even decided to move to a specific area?
Yeah, so the pandemic really made buyers prioritize family and friends more. But they're also able to do this because of their mobility from things like remote work. They're able to move further away where they're able to be closer to those people close to them, but also get a lot more for their money.
Where did you see the most migration to?
The highest percentage of movers move to the South. That's really where they're finding more affordability opportunities, but also some of the strongest job markets. So they're really poised for long-term growth as well.
And what has that meant, at least for the kind of mix of building and versus existing homes? I mean, are we looking at a lot of migration targeting where there are new home build-outs, or where there are existing homes that could be purchased for cheaper relative to where they might be migrating from?
Yeah, so as you can see, a lot of movers went to the South. They're looking for more affordability, but also better weather conditions. But those are also states where a lot of the more newer construction has occurred. So with more inventory means more opportunities for affordability.
And so, as you're thinking about some of those top reasons that clients chose to purchase a specific home, how much of that and the mindset could also permeate into next year and even show up in the 2024 data as we're rounding out the last several weeks here?
Yeah, so these are trends that we expect to continue. People are really looking for ways to be able to get into this market and compete. They're also looking for lower and more favorable tax rates, especially to combat insurance costs that are really rising in the housing space. And a lot of that occurs in the South, and that's really where people are moving, especially retirees and remote workers.
And so let's go into that remote work report of it a little bit more. What did the report tell you about job location and how being able to be virtual versus needing to go or have a close proximity to an office or hub somewhere? How did that play into the moving decisions?
Yeah, the report really highlighted the prominence remote work still has across the country. The majority of respondents said that their job location did not dictate their purchase location decision because they're still working fully remote. However, movers in the Northeast, the majority of them said that they're working at least part-time in office, and therefore their location is dictated more by their job location.
Matt Christopherson, who is the Director of Business and Consumer Research at the National Association of Realtors. Great to have you here with us today. I appreciate it.
Thanks for having me.
Well, tech is taking over the healthcare space with almost 1 in 3 Americans using a wearable device like a smartwatch, a ring, or a band. And that's according to a 2023 survey by Health Information National Trends. And these devices are even part of healthcare plans. Policyholders, they're able to use flexible savings and health savings account dollars to purchase these devices. And some insurers even offer incentives like lower premiums for using wearables to complete challenges and track their health. Joining me now, we've got Tom Hale, who is the CEO of Aura, the company behind the popular Aura Ring wearable device. Great to have you here on the program with us. Just take us into how you've been able to craft this product, knowing that as you're looking across the consumer landscape, that there are more people that want to be able to use this data to decrease their spends in healthcare and some of the premiums that they're paying.
Well, thank you, Brad, and appreciate you having me on the show. I think it's important to recognize that healthcare, honestly, is the cost is really borne by your insurer. And that the reality is that if you think about all the things that might possibly kill you, maybe 20% are going to be related to your DNA, your genetics. Maybe 20% are going to be related to your environment or maybe an illness that you contract. But the balance, call it roughly 60%, are going to be affected by your behavior. So the choices that you make in your life are really the secret to long-term health. So, well, what does a wearable or a ring wearable like this have to do with that? Well, this is a tool for you to become the CEO of your own health journey. It's partially education, it's partially an early warning system, it's a check engine light for your body. It teaches you about the dynamics of what normal health looks like for you and gives you insights when you realize that something's changing. It also fosters healthy behaviors. Healthy behaviors, we all know what they are, right? Sleep well, eat well, get exercise, stay connected to your community. If you can foster these behaviors, and if you can emphasize these behaviors, and you can change people's behaviors, you will have a major impact on health.
Right.
And the reality is that affects the impact of cost, because most of the costs occur late in life, during aging, when heart or metabolic or other issues crop up, whether they're cognitive health like Alzheimer's or Parkinson's, these are the costs that really are the burdens both on the individual and on our society.
Certainly.
So preventative health is the key. And a wearable, a tiny device that you start wearing now, if it changes your behavior, Brad, I guarantee you will have a much longer, but more importantly, healthier life.
And so, Tom, as we're in the middle of, for many people who have an employer-sponsored healthcare plan or at least share the payments, all of these things consider, open enrollment is the season that we're in right now. And so as people are trying to figure out, what their contributions to healthcare spending accounts or flexible spending accounts may look like and how that can be used towards smart devices that will help them track and get the data that really gauges how some of those actions that they're trying to take are actually contributing to their overall status as being more healthy. How can they make sure that, and how have you been able to go about making sure that you've got the partnerships to ensure that they can offset some of the costs for devices like this with some of those flexible spending and healthcare savings accounts?
Well, you said it best. Health is wealth. And by calling out your HSA, healthcare savings account, or FSA, flexible spending account, that's a really great opportunity for access for something as powerful as this very, very small, long battery life device that you wear 24/7. We were one of the very first wearables to be approved for HSA, FSA, and of course, for those of you who don't know, those are pre-tax funds, and you can use them to purchase an Oura ring and reimburse your cost, not just for the hardware but also for the ongoing subscription, using those funds. That provides a huge asset because that's something like, the tax savings that you get can be applied directly to your health. My advice to folks would be, to take advantage of their FSA or HSA account as much as possible. Pre-tax dollars, as we all know, are incredibly beneficial. The kinds of things that you can purchase with those things, there's a wide range of things that you might get for your health. Among them, this really tiny wearable that I think is very, very in demand and very desirable right now. People really want to gain access to giving their body a voice. Mm-hmm. The other way we see access is really working with insurers. And we were one of the first companies to work with the Medicare Advantage program. Our partner here is Essence Health. Essence Health is a Medicare Advantage program that is really targeted towards seniors. They are really trying to change the way seniors maybe take control of their aging process and have the metrics and have the data to change their behaviors in a positive way.
Tom, just lastly, while we have you here, there's a potential battle brewing with the healthcare industry right now, as President-elect Trump has made some statements about what may happen to the Affordable Care Act, what type of reforms may come forward. How would that impact the number of people that are able to tap into using spending dollars or being able to purchase a smart device and ultimately use that for their healthcare journey? And what would your advice, what would you hope to see from the incoming administration with regard to the healthcare industry so that we could use more data like that which is being garnered from companies like yours?
Well, my advice is, as always, that people should take charge of their own health journey. You can depend on medical interventions late in life when you're suffering from either some illness or something that's really about sick care. And by the way, it's incredible what medicine is able to do. But really, the most important thing that you can do at all ages is to foster healthy habits. And that includes, getting enough sleep, making sure you're eating healthily, making sure you're getting exercise. These are the behaviors that if you build them into your lifestyle and build them into your life, you end up with a longer health span. Now, what the government does and what the president-elect does, I think remains to be seen. I don't believe that anything is going to try and reduce the health in this country. We have already a little bit of a health crisis. We have, we spend the most of all the modern industrialized countries. We have some of the worst outcomes in terms of all-cause mortality and overall lifespan. And I think it's going to be really important for the government to take a look at what are the things that we can change. I do believe that nutrition is one of the core things that actually is key to provide accessibility to everyone. Healthy, non-processed foods are one of the foundations of health alongside of sleep and exercise. So we are really hopeful that we're going to see some very positive changes coming through for the nation's health. Now, Of course, there's nothing stopping you today from going ahead and making some lifestyle changes that are going to affect both your health span, your healthy lifespan, and your lifespan, your overall life, duration of your life.
Tom Hale, Aura CEO. Tom, good to grab some time with you here. Thanks so much for hopping on Yahoo
Brad.
Finance with us. Appreciate it.
Appreciate it. Take care.
You too. Seniors may face an unpleasant surprise come January. Medicare premiums, they are rising, and the Centers for Medicare and Medicaid Services announced Plan B premiums and deductibles will increase in 2025. Here with more, we've got Yahoo Finance's own Carrie Hannon. Carrie, good to see you. How will 2025 compare with historic Medicare costs?
Yeah, great to be here, Brad. Once again, they've ticked up. This is the second year in a row that Medicare premiums have climbed by around 6%. They were higher in 2022, but that was an anomaly because of one Alzheimer's drug that kind of spiked what they were going to be that year. Otherwise, this is the highest Medicare premiums have been in quite some time. So it is a concern. And deductibles have also jumped up this year.
And so will the cost of living adjustment offset this? And how much are we anticipating will vary based on income?
Yeah, thanks, Brad. Here's the thing. Your Medicare premium is taken out, the Part B is taken out of your Social Security check before you get it. So seniors are definitely going to feel that. The cost of living adjustment this year jumped up to what would be for someone who got an average monthly check of $1,900, about $50 a month extra. But when we weigh in the increased premium, which might come to roughly $10, this is for that average check, and then the increased deductible, which bumps it up another $17, we're talking a bit of a squeeze here for seniors that they might not expect, considering that many of the prices of things that they currently buy really haven't dipped down and that are still quite expensive at the grocery store and medical costs. So it is a concern.
What are some of the...
go ahead, Brad. Sorry.
I'll let you finish. I was just going to ask, what were some of the deadlines that are on the horizon here too?
Yeah, well, first of all, you can open enrollment, keep an eye out. It's open till December 7th. So this is a time people can look to shave costs in their Medicare plans. But so if you haven't done it, do the shopping. But I did want to say quickly, I was jumping to say that you had asked me about income. And so the thing is that your Part B premiums are based on your income. And so it's adjusted, and income adjustment ticks up your premium even higher. If for singles, it's over $106,000 a year in earnings, and for a couple filing jointly, it's $212,000. And so this is a sliding scale. It adjusts every year, but it lags. It looks back to 2023, so there's a 2-year lag. So someone who's retiring now may face some of these extra surcharges on that premium bump that we mentioned at the top here to make account for the income adjustment. So everyone needs to be aware of that.
Yahoo Finance's own Carrie Hannon. Carrie, thanks so much for taking the time, breaking this down for us today. Appreciate it.
Sure thing.
Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's market update. Stocks higher today, led by the Dow with a record on President-elect Trump's pick for Treasury Secretary investor Scott Bessent. Here are 3 trending headlines you need to know this hour. Meta getting a boost after making Raymond James analyst current favorites list, a reiterated strong buy rating and a $675 price target. Analysts see Meta benefiting even more from AI. Plus, your cup of coffee may cost more as Arabica coffee prices jump to the highest level since 1997. The long-term impact of crop damage from droughts in Brazil is pushing coffee futures higher. And Bath & Body Works kicking off the holiday shopping season with a Q3 earnings beat, net sales of $1.6 billion and raised full-year guidance. It's thanks to collaborations, an agile business model, innovation and marketing. And that's your Yahoo Finance market update. For more on what's trending, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
When it comes to saving for retirement, it can be hard to know if you're putting away enough. According to new data from Principal Financial Group, there is some good news. Middle-income households are saving more than they initially planned. 77% are saving an average of 7.8% of their annual income, leading nearly half to say that they anticipate that their retirement will be better than they thought. Nobody hates that. Here to break down the details, we've got Jean Chatzky, who is the Her Money CEO and founder. Jean, thanks so much for hopping on Yahoo Finance, taking some time here with us. So let's just break down these figures a little bit more. How and why are people coming in above their expectations of their own savings?
You know, this was so surprising to us when we actually got our eyes on these numbers, because if you think about it, we hear story after story about a retirement crisis, about the fears that people have that they won't have enough money to live the retirement that they want. And here we're looking at middle income people, people who make between $50,000 and $100,000 a year. They're putting away almost 8% of their own money. That doesn't account for any matching dollars that they get from their employers. If they layer on a 50% match, that's getting them to a 12% savings rate. Yes, we would like to see them at 15%, but this is huge. And it really shows that people have gotten the message about the importance of putting saving for their own future atop the list of other financial priorities.
How have we seen this differ among certain generations as well, especially as we're looking primarily here with this data at the middle income households and the respondents there?
Yeah, we're seeing that Gen Z, man, they are rock stars. According to, again, data from Principal Financial, Gen Z is starting to save 10 years earlier on average than members of Generation X, also than members of the baby boom generation. If you just think about what people tell you is their biggest regret when it comes to retirement, it is always that they didn't start saving early enough. And the fact that Gen Z is jumping on this so early gives them those additional years that they need for their money to compound. Just to put this in perspective, we looked at Gen X, we looked at boomers, and only 35% said that they believed that they were doing better than their children as compared to those Gen Zers and millennials. 50% of those Gen Zers and millennials say they feel they are doing better than their parents. So when we talk about the American dream of being able to do better than your parents as being dead, this survey actually says not so fast.
Jean, as we think about those who are perhaps looking for some tips and feel behind in their savings, how can they make sure that they're taking steps to catch up to their ideal and their target number?
Well, we do want people to be aiming for a 15% savings rate. And that's because that's what it's shown in tandem with Social Security, what has been shown to be necessary in order to be able to pretty much replace your standard of living once you hit retirement. So you want to max out any matched savings first. That is truly free money. Grab all of those matching dollars. Then you want to look at any other tax advantaged savings that you have available to you, whether we're talking about additional IRAs, whether we're talking about putting aside some self-employment income, whether we're talking about a health savings account, as you were earlier on this show, that can prove to be a really helpful supplemental retirement account, because if you don't use the money for medical expenses, you can spend it down in retirement, and it's treated very much like a 401k. And if you feel like you don't have enough money to save, the thing to do is to just really go back to basics and do an audit of your spending. Look at what's coming in, look at what's going out, look at where it's going. There are lots of apps and tools that can help you do this, but simple things like canceling subscriptions that you're not using, like reducing the amount of trips that you make to the grocery store because you've decided that you're going to eat home 1 or 2 nights additionally each week. Those can make a huge difference.
Jean, thanks so much for taking the time here with us today. Jean Chatzky, Her Money CEO and founder, joining us here on Yahoo Finance. Let's do a quick check of the markets here as we're taking a look at, and we've made our way over to the Wi-Fi Interactive. We are just a few minutes away from the midpoint of today's trading activity, and taking a look at the major averages here. The Dow Jones Industrial Average holding on to gains, fractionally as they may be. It's up by about 0.7%. We've seen that continue to try and be in rally mode here. Take a look at the past 3 months as well for the NASDAQ Composite, and you're seeing gains over that course of time. We'll just put this over the year to date so you can see exactly how far we've run for the tech-heavy average over the course of this year, up by about 27% here today, fractionally higher by about 0.4%. And oh yeah, since you're probably going to add some of that context to the Thanksgiving table when you're talking about your own portfolio and some of the gains that we've seen in the markets during 2024, the S&P 500, 25% higher during 2024. And here on the day, it's up by about 0.3%. I do want to take a look very briefly at some of the sector activity that we're tracking here on the day as well. 11 S&P 500 sectors. We started off the day stay green across the board. We do have a little bit of slippage right now in utilities and energy. Energy bringing up the caboose. That's down by about 1.3%. But taking a look at where you're going to be spending perhaps later on this week when you're looking for some of those deals out there, consumer discretionary, you're seeing that leading the pack right now by about 1.7%. Speaking of deals, coming up, what are the best Apple products to buy on Black Friday? I talked to an expert on wealth. Coming up next. This week on Yahoo Finance's Financial Freestyle, host Ross Mack sits down with Chris Lyons, who's the president of Web3 Media. They discuss the differences between Web 1, Web 2, and Web 3. Let's listen.
Where you could actually read things on the internet, right? And then the next component was the write era. So you have read and write. That's what we call like the Web 2. And then you saw companies like Facebook and Pinterest and Airbnb and like so many different businesses in the 2010 era. The big difference between what was going on in quote unquote Web 2 versus where we are now with what blockchain technologies can really encourage is this ownership layer.
New episodes of Financial Freestyle air Mondays, 12 p.m. Eastern Time. You can catch them on Yahoo Finance or wherever you get your podcasts. Well, $170 million, that's how much audiences spent at the movie theaters this weekend to see both Wicked and Gladiator 2. Joining us now with more is Yahoo Finance's own Alexandra Canal. Allie, what kind of demand did we see for the theatrical experience over the weekend? I know my dollars are in there somewhere.
Oh yeah, same with mine.
Yeah.
Demand was huge. The bulk of that coming from Wicked, as you were just seeing on your screen, $114 million at the domestic box office compared to $55.5 million for Gladiator 2. Wicked was also the highest grossing domestic opening day ever for a musical adaptation. I saw it. I loved it. I'm a huge fan of the musicals, and my expectations were high, and I gotta say that it did deliver. Now, part of that success stemmed from the $150 million marketing campaign that this movie committed to, which was basically felt across every major touch point, over 400 different partnerships from luxury brands to more affordable retailers like Target. So clearly a strong start to the Thanksgiving box office week.
So what are the top ways that theater goers can save if they are going to see it in theater? I mean, I don't know. I've kind of gotten to the point where if I'm going out, if I'm putting on shoes to go watch a movie at this point, I'm just going to go all in on the experience.
Right, totally. And we have been seeing that, but at the same time, ticket prices have been rising, right? They're up just shy of 10% since 2021. That's according to box office analytics platform Intelligence. Now, most people did see these movies at standard theaters as opposed to premium locations like IMAX. We saw ticket prices range from as low as $12 for a child ticket to as high as $18 for a general ticket at a premium theater. There are ways, though, that you can save. So a few quick tips. One, join a rewards program like AMC Stubs A-List or Regal Unlimited. There are often deals from these subscription-based programs, especially if you're someone who goes to the movies often, or perhaps you just know there are a lot of films coming out that you'd like to see. Another thing you can do is go at discounted showtimes. So during the week, in the middle of the day, oftentimes those ticket prices are less expensive than if you go on a weekend at a prime time 7 p.m. showing. Finally, you can also buy movie tickets and gift cards at discounted prices at big box retailers like Costco, BJ, Sam's Club, which is something I didn't initially realize was possible. So there are options out there if you're a movie lover and you want to save.
Well, you can judge by my face. I didn't know that was possible
Yeah, I know.
either. All right.
Fun.
All right. I'm going to write that one down. Allie, thanks so much.
Amazing.
Well, Black Friday sales are already in full swing, and if you're looking to snag some low-priced Apple products, look no further. But not all products or retailers are created equal when it comes to getting the best deal. Here with more and her tips, we've got Bridget Carey, CNET's editor-at-large. Bridget, great to have you back on here with us. Let's run through some of these deals that are actually worth it. Let's start with what's worth it, perhaps.
Hey, Brad. Yeah, I think when you don't see Apple products go on sale that often, you might want to grab everything. But I'm looking here, and there are some pretty good deals. You have like an iPad 10th generation, so not the newest model, but it's going for $280, $270. That's pretty good considering it has a redesign with it. Because sometimes you're going to see sales also. I mean, we're just talking about what's worth it, what's not. If they're going to see sales for something that's a 9th generation iPad, that's $200, and you think, oh my gosh, a $200 iPad, I better grab it. And I'm telling people, let that one slide on by, because sometimes when you get tech that's a little bit too old with processors that are, from 2019, say with that model, you're looking at longevity being the issue. Do you want an iPad that just plays a few movies on the airplane? Sure, it's going to do the job. But how long do you want that machine around? And that's what you have to keep in mind for all sorts of tech deals, really.
Apple is not a company that is known for its deep discounting. It usually comes from some of the retailers that are out there, perhaps trying to work through some of the inventory. So which of the retailers that carry these products are already putting out the best deals?
You really have to be savvy on all the little small things in the descriptions, because let's say you're looking for a MacBook Air laptop, for example. Just a month ago, Apple announced that from now on, all their Air laptops are going to have more RAM, more memory, so 16 gigs, but for their latest model. But now retailers are going, hey, I got to get rid of the old inventory, right? So they're discounting ones that have less RAM. So you might see a sale that has the new RAM, the old RAM. You got to look for, what exactly you're getting. Just don't look for like MacBook Air. I would also say another deal to watch out for is the thing I'm wearing right now, the AirPods Pro 2. This is an old device, but it got a new software upgrade that this year makes it a hearing aid. It has a lot of hearing health features just to protect your hearing. And they're down to $170. So I think something that is just not necessarily brand new is going to be really hot this year. And also Apple Watches. You don't need the latest Apple Watch 10, which still is on sale. We're seeing sales still on the discounted Apple Watch 9, and they are all still giving you this overall picture of your health. And I think that's a big trend to look for. People just are kind of over the whole step counting thing. Like, yeah, sure, everyone could do that. But now, how am I doing in my sleep, plus throughout my day, plus how's my heart? And you're getting these bigger pictures on how you're doing overall. That's the new trend going into 2025.
As we compare the in-store versus online deals, which are seeming better for some of the potential buyers out there?
I used to be the one who busted down the door. Okay,
Just
so
kicking
I
in
do-
doors out here, Bridget. Wow. Okay. All right.
I have a fondness for the old days, but I gotta say that when it comes to just price comparison, we do have an advantage now for being online. I mean, you're gonna find great deals if you're an in-person shopper and you want to really touch that product and see what it's made of. Go ahead and do it. But when it comes to price comparing, I go online and you can still price compare in the store while you're in that long checkout line. Go down your phone and just start Googling to see, like, does someone else have a different deal? And if you go to the cash register and and there's someone there to help you, you could say, hey, this competitor has it for cheaper. In years past, I have gotten places to lower the deal to match.
Okay, just lastly, while we have you here, and we got to go in a hot second, but the AI features that Apple has been talking about for its newest products, are we likely to see a lot of those products on sale this year? And what's the demand look like, especially as you're going to have perhaps just an aisle over, or even in the same aisle, some of these deeply discounted older models?
When it comes to laptops, anything with an M chip, that's going to have Apple Intelligence in it. But I will say that the older iPads you're seeing, they're not going to have necessarily Apple Intelligence in them. So, how important is that to consumers? I think we're in the early stages of that now. With the new iPhones, yes, people might be upgrading their phone to be able to take advantage of that. But really, this is a long rollout kind of experience where you're getting more summaries and being able to, ask the computer to write an email better for you. It's not something that I feel people are going to be shopping for because they're not going to see it really until it starts to roll out in pieces throughout the next year. So count on that being a bigger deal next Black Friday.
Bridget Carey, editor-in-chief at CNET. Always a pleasure to grab some time with you, and happy holidays.
Thanks, Brad.
Thanks. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination. Julie Hyman and Josh Lipton got you coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close.